Welcome to part 2 of the only class on how to build wealth and gain financial freedom that you'll ever need, which also happens to be free because I don't have to sell you this because I've already done the stuff that this class teaches. Now, if you haven't seen it yet, I recommend that you start with part 1, which is also available completely for free. That part is about how to make more money and spend less of it, and you really need both of these components in order to build real wealth. Also, as a reminder, this free class is also available on the Icario.com website in the form of an online course where everything is like divided up into chapters and structured, and it comes with written notes and links to resources, and it's basically a bit easier to navigate, and I prefer it, but it is also completely free. And if you think that is too much to go to a different website and you just want to stick on YouTube, you can watch the entire thing here. It's time that we start talking about investing. This is where we get a return on our money. We want to put our money to work to make more money for us, and we want to get to the point where we basically get paid to be rich. So let's look at how investing works and how to do it. And by the end of these lessons, you will understand everything about brokerage accounts and investing apps that you can use. We'll talk about robo investors and ETFs and index funds. We'll talk about real estate trusts, and the various myths around real estate investing. We'll talk about crypto exchanges, wallets, and crypto trading in general. And we will also talk about a slow death that banks are dying and what is currently rising up to replace them, and how you can benefit from this transition happening. Also, very importantly, we will talk about why most people lose money when they try to make money investing. And we'll talk about what you can do to avoid being one of them. And to do this, remember, knowledge is power in the game of money. We will start with the very basics. We'll start with the very basics of how does investing work to make you more money. But let's start with a very basic example. This is Jill, this is Bob. Jill has a business idea. She wants to start a business, but she doesn't have money. Bob doesn't have a business idea, but he has money. And so they basically make a deal. Bob says, listen, I'm going to fund your business. I'm going to give you the money you need, to buy space and to hire people and to buy machines or whatever you need to start your business. And in exchange, I want a share of your profits. I basically want to own part of your business because I'm giving you this money to start it with. And, Jill says, well, okay, that seems like a fair deal. I couldn't start this business on my own, so you give me the money to help me start it, and in exchange, you basically own part of the business. So let's just make it simple. You own half the business, right? It's going to be a 50-50 split. I'm the entrepreneur, you're the money, and we split this 50-50. So with this, Jill starts her business using Bob's money, and things go well, and she starts earning money. And because Bob owns part of this business, he gets part of the profits. So he makes a big investment up front, and at some point later, when Jill's business starts turning a profit, he starts getting payments every month or maybe every year or whatever it is, where he gets a portion, he gets 50% of all the profits that Jill's business makes. And this is a great deal for both of them, right? Because Jill couldn't have started this business without the funding, so she wouldn't have made any of this money. And Bob is making a return on his investment, which is also great for him, right? He's basically at this point just making money for free, essentially, because all he did is put his money in, he didn't do any work. Now, this sounds great, right? So let's just do this like 100x over as much as possible because it's free money, right? So hold on. There is also a downside here, and there's a risk that Bob takes on. So first of all, the risk is that, well, what if Jill's business doesn't work out, right? If she just goes bankrupt, lots of businesses fail, right? Things go wrong, who knows? And the whole thing just goes bankrupt. Well, at this point, Bob can't be like, well, give me back my money. Well, guess what, man? Your money's gone, right? So you can't get your money back. There's a chance here that instead of making free money in the future, you lose all the money you invested. And that's a risk that Bob takes on as an investor. And also because of this, for a riskier business, Bob will want a greater share of the company for the same amount of money. So think about it, right? If the business Jill wants to start is like, well, I want to open a cafe in this part of the city. Well, this is not a very risky investment because you can look at, well, you can estimate the costs of what will it cost to run a cafe, how many tables will we have, and you can look at how much revenue do other cafes in similar locations make. And you're not trying to do something that's never been done before. Right? It's just like, okay, if you have a good location and you execute this well, it's not going to be $1 billion business. We know that it's not going to be anything crazy, but we're not taking on a huge amount of risk either. However, if the business Jill is trying to start is like, I'm going to revolutionize medicine with some kind of a new genomics treatment thing, it's like, okay, well, if that works out, that could be huge, but it's also a massive risk. It's pretty likely to fail. And so that will factor into how much Bob is willing to invest and how much of a chunk of that company he wants in return. So that is the risk part of the equation. There's also a liquidity problem here, because what if Jill needs more money than Bob can invest? Well, at this point, we'd have to get more investors involved, and then we have to split the pie in different ways and so on. That could get complicated. But also, what if Bob needs his money back before Jill has made enough profits? So it could be maybe 2 years down the line. The business is profitable, but for some reason, Bob needs to get his investment back. He needs all that money all at once. And Jill is like, well, I'm sorry, we're profitable, things are going well, but we haven't made enough in profit to get all of the money you put in back yet. So again, I can't give you this money. So these are some problems that this simple investing scenario represents. Now, for this liquidity problem, in fact, for both of these problems, there is a solution that we can imagine in our simple scenario, which is someone looks at this deal here and says, I'm going to come in. So a new investor comes in and says, you know what? I'm going to swap places with Bob. So don't worry about getting your money back from Jill. I'm going to buy your shares. I can see that you're already making a return on this investment, and I would like to get that return. And in fact, because this business is already running, like when you made this investment, it was a bigger risk. It was a bigger risk because it wasn't sure if this was going to be profitable at all. At this point in time, I can already see that it's profitable. So I'm actually going to buy your share of the company for a higher price than you originally invested, right? This share of the company is now worth more because the company is already a bit more mature and already making money than when you originally purchased it. So this is how we can solve that problem. If another buyer comes in and says, I'm going to just buy your shares, then Bob can get his money back. He can get a whole chunk of money. And the new investor instead gets those recurring returns. Now, when you understand this simple scenario, you understand the most important mechanisms of markets, right? Lots of market complexity has emerged to solve these kinds of problems and to remove friction from this whole investing process. And if you look at the stock market, it is basically a highly complex, like scaled up, abstract version of Bob investing in Jill's business, okay? That's basically it. What if you have hundreds of thousands of businesses, billions of potential investors, all like swapping places and choosing to invest here, choosing to invest there, and so on? That's what basically the stock market ends up being. The reason I started here with something so basic is this. The most important thing you need to understand before making an investment is you need to understand, where does the money come from? Okay, if I'm going to invest my money here and then get returns of some kind, where does that money come from, right? Why do I put money in now and later I get more money out, or I get a monthly payment, or whatever it is? You have to know, where does this money come from? And the reason you have to know is because it's the hallmark of all kinds of scams and Ponzi schemes is guaranteed returns on investment that are just too good to be true. These things have been around since forever. And they also basically work the same. Like, you can find scams from 100 years ago that use the exact same formula that scammers today are using, okay? This same stuff has been around for so long. And I've seen so many versions of this. So many bad financial decisions could be avoided. So bad financial decisions that people make all the time could be avoided if they simply ask the question, hold on, where's this money coming from? If I put money in and you're telling me I get this return, where does that money come from? And I'll link to this below. A really good educational and entertaining educational source on this is a YouTube channel called CoffeeZilla. And here's an example. He basically talks about these types of scams quite a lot. And here he had a series of videos on like TikTok scams, where people were making these kinds of claims like, I'm going to teach you how to do, Forex trading. and get a 1% return on your money every single day, right? So you start with $100, the next day you have $101, and then you reinvest that, and then you have like $102.10 or whatever it is. And you keep scaling up, right? And they have some secret formula or whatever. And there you can simply ask, hold on, if this is true, where does this money come from? We can also revisit our friend, the compound interest calculator, to get a better view of this. So let's say we start with $1,000 and we manage to make a 1% gain every day, and we compound that every day. This is usually the pitch, right? Every day you reinvest yesterday's profits. What happens if we do this for 1 year? Let's calculate that. So what we get here is we start out with $1,000 and we appreciate our investment by 3,600% in 1 year to end up with $36,783 from just $1,000 only through reinvesting 1% every day. Needless to say, getting over 3,000% returns in one single year is an insanely good result, but also what happens if we just keep going? Because compound interest does interesting things, doesn't it? So let's say we keep this going for 5 years, still 1% a day, and we never put in more money, by the way. This is one time, $1,000. After 5 years, we have $77 billion. So with $77 billion, you're already pretty close to the top 10 of richest people at the time of this recording. Let's see if we add just one more year. Let's see what happens here. Okay, now you're the world's first trillionaire only about 5.5 years into this process, starting with $1,000 and only reinvesting 1% gains every day. So if we look at this, we can ask ourselves, first of all, where does this money come from? Is it really possible to make these kinds of returns consistently? And also, if someone actually knew how to do this, would they be telling you about it on TikTok? And would they be selling you a course on how to do this for $50 or $100 or even thousands or 10,000s of dollars? It just doesn't make any sense. And so just looking at the claims that you'll often see and running the numbers, running the calculations like this can already create enough skepticism. And again, if you can just ask yourself, well, where would this money come from? How come you're able to get these gains? Like, who's on the other side of this trade, basically? Somewhere, this money has to come from somewhere. So even just asking this question can give you enough skepticism to basically avoid like 99% of scams out there. So having said that, where does the money from a legit investment come from? For this, we can go back to this simple scenario here because we've actually already looked at the two major sources of returns. The first being having a percentage, like owning a percentage in some kind of a, getting economic return, right? So Jill's business is creating something of value in the economy and people pay for it. And Bob, as the investor, gets a slice of those payments. And this is something you can also get with stocks, right? Some stocks, so you can buy, Microsoft shares or something like that, and they will pay you dividends, where literally you get a slice of their profit proportional to how many of their shares you own. And you're basically just participating in, okay, Microsoft is creating all this stuff. Microsoft is creating economically valuable stuff. They have customers that give them money. And because you own part of Microsoft, you now get some of that money. That is one of the legit sources of returns. The second source of returns is what we showed here with a new investor coming in. Another investor comes in, wants to buy those shares, and is willing to pay more money than Bob originally paid. We can roughly categorize these two types of returns as, number one, fundamental returns. So you have a share in economic activity and profitable returns. And number two, speculative returns, where you basically believe that the next buyer will pay more. Okay, so you buy something because you think, in a few years or maybe even a few days or something, right, someone else will come along and be willing to pay more than I paid. This here is actually pretty powerful stuff. And you'll see I'll get back to this in a bit of a cheeky way. It's astonishing how knowing this and understanding this can reframe a lot of parts of the financial world. in ways that really like the mainstream media and so on really doesn't want you to think about this too much. But I'll show you an example of that coming soon. Okay, so with this, the reason we went through all this is that I think that now you are armed with the knowledge that you need to not just get completely wrecked as an investor, okay? People who don't understand this, people who don't ask these questions are very efficient money-losing mechanisms. And in fact, people who don't understand this stuff, they come into a market, they make all the mistakes. They're basically giving their money to other investors in that market, right? Other people can easily exploit those who don't understand these basics. So this is a good place to start. Let's talk a bit more about investing. And I know how you probably feel at this point. Enough of the theory, just tell me how to make money already. So yes, we are getting closer to that. So let's talk about investment and investment opportunities. And first of all, many investment opportunities are inaccessible to most people. So, if you want to invest in some new startup or something, you probably can't, unless you know the right people and unless you're an accredited investor, and you probably just can't get in on that. And here, I'm not going to talk about those kinds of investments. I just wanted to kind of mention, right, there's a huge world of investing. Again, there's basically much too much to cover. But what I'm going to focus on are the most accessible types of investments. So here are investment vehicles that basically almost anyone, almost anywhere in the world can access. First, we have stocks, equities, shares. Those are the same things. Those three terms are most commonly used. That is when you go to the stock market and you buy shares in a company, essentially, right? You buy, or the shares you buy represent a percentage, a slice of an existing publicly traded company. So stocks, equities, shares, that's all the same thing. Another thing is ETFs, that's exchange traded funds or index funds. And this is basically an entire basket of shares, where instead of buying a specific company, you say, oh, I like Apple, so I'm going to buy Apple stock or Apple shares. You just go, you know what? I think that in general, the stock market is going to go up, so I'm just going to buy like the top 500 companies, in equal measure, basically. And you can buy an index fund. You can essentially buy a fund that just invests in the top 500 companies in the stock market equally, and that's it. You kind of just let it ride. And so you don't have to pick individual winners and losers. And we'll talk a bit more about that later as well. But these things are called ETFs, exchange traded funds, or index funds. Then you can also easily access commodities. So that's, whatever, lumber, copper, silver, precious metals are maybe not commodities, but I'll just lump them in together here. Oil, whatever it is. You can also buy this kind of stuff, usually in the form of futures, or at least for some of them. You can also foreign exchange, Forex, so you can exchange currencies between each other, options, and a whole bunch of other stuff. I'm lumping all of this together. This is kind of the more complex stuff and the stuff that you probably shouldn't even consider, and we'll get back to that. Then we have bonds and savings accounts, which again, I'm just lumping these two together. Bonds are generally considered the lowest risk type of investment, and the returns are usually really, really low. The returns are usually lower than inflation, and so it's really, again, it's basically not worth it. Same with savings accounts, right? You can get your 0.01% return in a savings account. It's not worth it. And real estate is another one. Real estate is, in different forms, differently accessible to people. The main barrier is usually just the price, right? You need quite a lot of money to get in, but we'll talk about that too. And then cryptocurrencies. So that's Bitcoin, Ethereum, and all the other cryptocurrencies. Those are generally the most accessible ones. Now, as you've already seen, there's many I don't recommend. So I don't recommend commodities, Forex, futures, options, and so on. These are generally considered like difficult, highly complex vehicles, kind of made for professional traders. Generally not a great idea for most people to get into this. The other thing is, bonds and savings accounts, the returns are just so low, it's not worth it. 99% of crypto projects, right? Most crypto coins you can buy are trash and just highly speculative, and much, much more likely that you lose money than make money on them. And the same goes for penny stocks. So penny stocks would be very small cap, basically small businesses that are listed on like stocks, right? Those are listed on the stock market. But because they're so small, they have like a lot more growth potential. They're usually a lot more volatile. They're usually also highly manipulated. And that's just one of the things. A lot of scams revolve around this. Oh, I'm going to show you how to pick a winner, because a penny stock, so a currently small, low value company, is much more likely to double in value than, let's say, Apple. It's like, how are they going to double in value? They're also already so valuable. So the idea is, on penny stocks, you can get better returns, but also you can just get wrecked much more easily. So generally not recommended. Now, what about real estate? So like I mentioned, the accessibility of real estate can be a bit of a problem, but I want to talk about real estate because it's like probably the most mainstream investment thing, the most recommended investment, the most talked about investment. So we'll have a separate lesson just about that. So what to do? Here's what to do. Set up a brokerage account. There are various services where you can create an account, and that will allow you, with an app like you see here on your phone or with a web app or whatever, will allow you to start buying and selling stocks and ETFs. And I recommend you do that. I recommend that you set up a brokerage account, even if you're not going to do a lot of this investing, even if it's going to be a pretty passive approach. I recommend that you do that and at least have a play with this, and I will provide a bit more guidance. But it's good to have a brokerage account. Now, when choosing a brokerage account or a broker, you'll have to look at what's available in your country, because this is country specific essentially, just like choosing a bank, right? I can't tell you what bank to choose because it depends on where in the world you live. So, but here's some stuff to look out for when choosing a broker and a brokerage app. First of all, look for low fees. And I say this because if you have a bank account with most banks, they will gladly offer you some kind of a brokerage thing. They will gladly offer you to buy and sell shares through them. But often the fees are just way too high. And you really don't want to be losing lots of money on fees every time you make a trade, because it just makes it really hard to get a positive return. So you want low fees for buying and selling these things. You want ideally access to international stocks and ETFs, so you're not just limited to what's available in your own country. You want a good user experience, decent user interface, something that this doesn't look like it was made in 1999 or whatever. And obviously, look for a trusted provider. Some company that's been around for a long time, has many users. It's pretty important that you can trust your broker. Having said that, here's what to avoid. Avoid zero fees. Don't use an app that doesn't charge fees, because listen, if they're not charging you anything to use their thing, then you're not the customer, okay? You are being exploited for the customer of that broker, and you don't want to be in that kind of situation, right? So don't use a tool that has zero fees here, because they are making money off of you somehow. Also, don't use brokerage apps that are like overly engagement optimized, right? That use all of these like mobile app tricks to get people hooked and to get people to spend more money and so on and so forth. You really don't want that. You want a more professional kind of stiff upper lip type broker. I think that's a much better deal. Also, find out if your shares are being lent out. This happens a lot. This is one of the ways in which these zero fee apps finance themselves. And first of all, so ideally it just doesn't happen at all. Your broker does not lend out your fees. If they do, there needs to be an option where you can turn it off, where you can say, no, do not lend out my fees, my shares. I don't want you to do that. That's important. And also look for crypto. This is pretty specific, but like crypto you don't actually own, okay? So some of these apps will be like, oh, you can buy Bitcoin, you can buy Dogecoin, whatever. But yeah, can I then transfer this Bitcoin to my wallet? No, you can't. So you don't actually own Bitcoin, okay? They're just cheating you in some way. Also, look for apps that constantly have server issues. When the price goes up or goes down a lot and people want to sell or buy, you suddenly can't, right? Because the server is down again. And all right, okay, if you're in the know at this point, I'm basically just calling out Robinhood, right? Robinhood has all of these problems. Robinhood is a very famous, very popular, successful trading app that has zero trading fees and that roped a lot of people in. And those people are very disappointed because Robinhood just keeps screwing its users over. And that's because Robinhood users are not the customers of Robinhood. Robinhood users are the cattle out of which value is extracted for Robinhood's real customers. And so it's not a surprise, right? It's like, of course, Robinhood users are having a bad time. They are literally there to be exploited in someone else's interest. So avoid Robinhood, but also avoid similar apps because, of course, Robinhood was successful. I'm not sure if it's going to stay successful for much longer, but it was successful. And so a lot of other apps have come out and imitated that. And, Robinhood, I think, is in the States only, but it's quite likely that in your country, if you're not in the United States, there's probably some, Robinhood copycat. There's probably someone who has started, the zero fees, super friendly UI, use us and you get a free share and all this bullshit. There's some app like that, right? It might be the most popular trading app that you find in the App Store, and you avoid it. And instead, you go with a much older, more established, more boring brokerage that charges you some fees, but not unreasonably high fees. What I recommend here is that you simply search for your country. You search for like a fee and price comparison of brokerage accounts that are available in your country. And that will give you a sense of who is offering what. And like I said, you can avoid the zero fee ones and you can probably find a good one to start with. Now, once you have a brokerage account, so you sign up and you'll go through a verification process. And at that point, you can either send money into your brokerage account with a bank transfer, or you can link it to a card or something. And at that point, you can buy and sell stocks at any time. And that means that you can start benefiting from the price movements of stocks. Now, to get a sense of what this is like and how this works, I recommend that you use Tradingview. So you can sign up for a free Tradingview account, and let's have a look at what that does. So this here is Tradingview. Right here we have a graph of how the price of, in this case, Apple to US dollars has developed over time, all right? And here, yes, okay, the free account, you'll get this pop-up all the time, but you probably don't need to upgrade. The free account is really very useful by itself. And the idea is this, right? If we look at this, we have a price development here. And by the way, we can search, you can just type to find anything that you want to track the price of. So Microsoft on the NASDAQ, this is the Microsoft stock, right? Microsoft shares. We can look at how the price develops in different intervals here. So let's say daily. In this case, every one of these candles here represents 1 day of price movement. And we can see here, at the bottom, we see the date. So we see this drop off here was in February, March 2020. That was the COVID drop off, right? The initial COVID shock, so to speak, sent a lot of prices down. And yeah, this basically shows us how the price moves. And you also don't really have to worry about these candles here. We're not going to get into that. Let's just make it a line, right? This is the price going up and down over time. And we can zoom in and out and get an idea of what's going on. Now, what we can simply do, we can use this measuring tool here to basically say, okay, let's say in October 2018, you buy shares in Microsoft, right? What happens over the next month, 2 months or so, 3 months basically, is the price goes down by almost 20%. So that means that if you had put in $1,000 on October 3rd, 2018, then by December 31st, 2018, the value of those shares would have shrunk to about $800, okay? So if you had sold in December, you would have lost $200. If you had kept holding on, though, until, when is that? Until like March 2019, at this point you've broken even. Now you can sell your shares again and you get your $1,000 back, so you've made nothing and you've lost nothing, right? Now, if you keep holding on, and this gives you a sense of how this develops over time, right? If you keep holding on here until now, you've made like 140%. That means your $1,000 would have turned into $1,400 over, what is that, 1,000 days? So that's like 3 years, right? Over 3 years, you could have turned $1,000 into $1,400 of value by holding Microsoft stock. That's basically how this works, right? You can look at this. You can look at it. I recommend looking at it in high time frames, right? Of course, you can look at like a 5-minute price movement here and be like, ooh, if I had bought here and sold here, I would have made 3%, which is actually quite a lot, I have to say. In 5 days, you could have made 3%, right? That's quite a lot for stocks. But yeah, it's not a good idea to get too obsessed with small price movements. It's a very good idea to look at daily and weekly price developments to get a sense of what long-term investing can look like. And you can do this, you can find all kinds of things here. So you can also find crypto, right? If we want to look at BTC. So if we look at the Coinbase price of BTC, here's a weekly chart, right? We can see when they listed it down here, it was what, $300. Now it's $35,000. That is how this thing, or $31,000, sorry. That's how this thing has developed over time. So here you can see, right, this is why some people are so excited about Bitcoin, because you could have made 13,000% if you had the patience to hold over this period of time. Now, obviously, what's also important to recognize is that there's also ways to lose quite a lot of money. Right here, you can, even if you held on to it for a year, you still lost 80% of your money. That's pretty painful, right? That's pretty painful. But this is something you can start looking at this and looking at how the prices develop of different companies, of different ETFs. You can also look at something like SPY, which is the, let's go here. This is a index fund that tracks the top 500 companies by market cap in the United States. And you can see how this price has developed over time. This is also kind of a representative of how the economy grows as a whole, at least this part of the economy. And playing around with this can give you a sense of how you can make and lose money by investing in these different vehicles. So like I said, all you have to do is sign up for a brokerage account, and then you can start buying and selling stocks anytime and start profiting from these price movements. And when you do that, you will probably lose money. And so in the next lesson, let's talk about why that is and how to avoid it. As we've discovered, there's a world of opportunity where you can put your money to work to make more money for you. And unfortunately, most people who try their hand at this lose money instead of making money. You know now that the goal here is to arm ourselves with knowledge. So we want to understand, why is this? Why do most people lose money? Because just going in and thinking, oh, I can make this work, I'm sure I can figure this out, is naive. And so we want to understand what goes wrong so we can avoid making the same mistakes most people make. So a really interesting thing to know about investing and investing returns is that here's how difficult this is. Different studies have shown that even hedge funds and hedge fund managers, so people whose job it is to actively trade and pick stocks, generally don't manage to outperform the market. So as you can see here, this is an article from MarketWatch that describes some of these studies that have been done that shows, roughly 1 in 20 actively managed funds beat index funds. So 1 in 20, that's not many. And in fact, it's even worse than that. Another thing that comes in is survivorship bias. So often when you look at, okay, how well are these different hedge funds or these different actively managed funds performing, you're actually only looking at the ones that are still around. And that leads to discounting the ones that have just gone completely bust. The takeaway here is that even people whose sole job and full-time occupation it is to choose good stocks to invest in mostly fail to make significantly profitable investments. So when I was saying that, if you just jump in and try to buy and sell some stocks and make some money, that you're going to lose money, it's like, this is why I'm saying it. Like, even people whose only job it is to make money doing this, even they really struggle to do it. So let's find out why this is and see if there's anything we could do about it. I hope that by now you've had a bit of a play with Tradingview and had a look at that. Because if you do, when you play around in Tradingview, you will notice a few things. And I want to highlight 2 things that will help us understand why it's so difficult to make good money in trading. So let's talk about the first thing. Here we are in Tradingview. We're looking at a chart. Really, this could be any chart. It doesn't really matter that much. But we can be looking at this and we can easily get the impression like, wow, I could really make a lot of money here, right? If you think about, what if I had bought here, okay? If I bought down here and then rode it out until here, I would have made 20%, right? It would have made 20% gain right here, and that's in like 2 days. Okay, so then you sell here, you wait until the price comes down again, you buy down here, all right? You buy down here, and you sell again up here. That's another 12% gain, okay? So you sell here, you wait till the price goes down again, you buy here next time, you sell here next time, is another 10%, and so on, right? When you look at it like this, you just go, oh, what if I, sell here, buy here, sell here, buy here, sell here, buy here, sell here. You can very quickly figure that I could be a millionaire like by the end of the year easily, right? All I have to do is sell when the price is really high and then buy when the price is really low. So why don't I just do that? So let's think this through and let's look at how this actually plays out. When someone comes in with the plan to do that, right? I am just going to play these price movements, play these swings up and down, and I'm just going to take home bags of money. That's what I'll do. So we're looking at an asset. This could be a stock, this could be Bitcoin, this could be Dogecoin, this could be anything that you can trade, right? Anything that you can trade through your trading app or through a crypto exchange or something like that. We're looking at this, and we're looking at this specifically, maybe you've read about it somewhere, or maybe you've said, hey, here's a great opportunity, buy this asset. And so you're looking at the graph and you think, okay, the price is going up, right? I'm seeing upwards movement here, so that's nice. Maybe I should buy, right? So I've heard good things about this. The price is moving up, maybe I should buy. So we place a buy order here, okay? We enter, we place a buy order. What happens next is, price goes down a little bit and then it starts going up and we have a 6% gain here, let's say. And you go, okay, nice. This is great, right? I'm starting to make some profit. What happens next? Price collapses. It goes down, it goes below our initial buy-in price. And so now we're actually at a loss. We are 15% from the previous price down. And we go, oh crap, this isn't good. I think this was, I shouldn't have listened to whatever that forum post or wherever that TikTok of the person telling me I should buy this. It seems like everyone's selling, right? It's just one red candle after another. People just keep selling and I don't want to lose more money. I've already lost. So I'm going to sell. So we sell here. And what we've done here is we've realized a loss, right? At this point, we're like 5% or 7%, 10%, something like that down in total, right? So if I've put in $1,000, I saw the price rise to above 1,000. Now it's down $900 left or something like that. And I'm selling. I've realized a loss, okay? But I'm like, okay, I'm out. I got out before the price collapses further. All good. But then what happens? Oh, crap. The price keeps going up. Basically goes back to the previous high that we had, right? And so at this point, it's like, oh, crap. If I had stayed in, I would still have a profit here, okay? But look, I bet this isn't going to last, right? I bet this is going to collapse again. I'm not going to make the same mistake again. And indeed, the price goes down, another 5% down, and we go, I knew it. I'm glad I didn't get back in, right? I'm glad I didn't buy. And, yes, I sold at a loss, but clearly this is going down, so it's good that I'm out. Oh, no. Next time we check, the price is up. We've gained like 20% from the last point. And now we go, oh, crap. If I had just not sold, I'd have a really significant profit at this point, right? That would be great. If only I had stayed in, okay? If only I'd stayed in. But, I don't want to lose money again, so I'm not doing anything. And then, oh my God, look at this. Look at this. The price shoots up by 30%. And now we're thinking, oh my God, I would have so much money. If I had just stayed in, I would have made so much money on this. And it's just, everyone's buying, right? It's just crazy, crazy buying. The price is going up like crazy. But this can't last. It can't keep going, right? So I'm not going to buy. It keeps going up. Okay, we've made another 20%. We've made another 20%. Okay, clearly at this point, the price is just going up. This is going to 10x. This is going to 100x. And I'd be a fool to miss out on this, okay? I was clearly right the first time. I just made the mistake of selling too early. This is clearly going up, right? Like I said, 10x, 100x your money. This is it, right? So we're buying in again. And indeed, it keeps going up, all right? We've made more profit. And this confirms you're right. This is indeed going 10x, okay? You want to 10x your money? Well, you want to 10x more money, right? So let's buy some more. This is going up. This is going to the moon. Except now the price is going down again. But now we've put in a lot of money, right? We've put in a lot of money and we're down, but not by a lot. And it's like, come on, this is just a dip, right? There's nothing to worry about. And it's still going 10x. If anything, this is a buying opportunity, right? So let's buy some more. So at this point, we're really deep in. We've basically put all our cash into this with the absolute conviction this is going super high. And then something very painful happens. We have like a 40% drop. And now we're really, really in the red. We've lost a lot of money. But this must be coming back, right? It's like we're too deep in here. And just like a few days ago or maybe a week ago or something, people were all hyped about this. Everybody was talking about how rich everyone would get, you know. We've got to stay in. I mean, this has to come back, right? And it goes down further. There's another 20% down. At this point, it's like so much money lost, okay? So much money lost. It hurts in your soul how much money you've lost now. And it simply looks like it's going to zero, okay? So now the question is just like, well, do you want to lose all your money? Or do you want to at least pull some of it out, right? So it's time to sell. So we sell it all. We sell it all at a huge loss, but at least we've gotten our money out before it goes to zero, right? And then it kind of starts climbing up again. And it's like, okay, well, was I wrong about this? Like, should I buy again? I'm basically out of money, right? I lost so much money. I don't know what to do now. But okay, maybe it was right. Maybe everyone was right when they said this is going to go 100x. So let's put our money in again. And of course, it goes down again. And at this point, it's like, this is all a scam, okay? I hate this. I've lost so much money. It's embarrassing. It hurts. I don't want to tell anyone about this. I hope nobody finds out how much money I lost here. I'm just going to sell it all at a massive loss, right? So if I started with $1,000, maybe I'm getting like $200 back out. But probably I went too deep, right? And I spent much more money than I can afford. And it's a disaster. So we sell here. And then, the price goes and keeps doing whatever it's going to do because it doesn't care, right? The price just keeps going up and down and sideways and whatnot. It's just now I'm no longer emotionally invested. But this is essentially how the story tends to play out when we try to time the market. Now, and by the way, this is a real price graph. Okay, I didn't make this up. This is a real price graph. And I guarantee you lots of people made exactly these trades as this was playing out. Now, if we just hide this graph, what we see here is we see our entries and our exits or our buys and sells, right? So we bought above this green arrow and then we sold at a lower price below this red arrow. Okay, so we lost money here. Then we bought high and very high and we sold low. And then we bought high and we sold low. So somehow we have managed to do perfectly the inverse of what we're supposed to do. The basic idea with trading is that you buy when the price is low, you sell when the price is high. That's how you make a profit. That is obvious, right? In fact, that's so obvious. Why even say it? It is so obvious. Everybody knows this. And yet, we have managed to do the exact opposite. We have managed to almost perfectly buy high and sell low. We have managed to use these price movements to simply lose money. It's important to understand that when we're looking back on a graph and we're thinking, oh, I could buy here, sell here, buy here, sell here, and make lots of money, we are fooling ourselves. Because looking back on a graph, you can always see what's going to happen next. But when you're on the ride and prices are going up and down, you get very emotional about it. And unfortunately, your instincts, your emotions, your monkey mind will always lead you to make all the wrong moves. Trading a market is almost perfectly counterintuitive. And also, if you're just thinking, oh, I'm just going to do the opposite of what my instincts tell you, well, it's also just random enough that even if you manage to counter trade your instincts, you're probably still going to get wrecked. It is like almost the perfect combination of counterintuitiveness plus randomness that makes you lose money. It makes the human brain do the things that make you lose money. And this is in part the reason why even professional traders have such a hard time. A big part of the reason is it's just so difficult to overcome your instincts, your emotions, your reactions to what's happening in the market. It's just that difficult. And even if you manage to completely overcome that, there's still enough randomness, unpredictability, and so on going on that it's just difficult to get significant amounts of money out of this. Which isn't to say it can't be done, right? Some people do it extremely well. But the thing is, just most people can't do it. But there's another thing here that we need to consider, because what we're talking about here is like these professional traders, they're not beating the market. And here's the other thing that you probably notice when you're playing around with Tradingview. If we're looking at some companies that we know about, and some I've mentioned, let's look at Microsoft, right? Microsoft, and let's look at a long time frame. So let's look like at a weekly, maybe even a monthly chart. Okay, this is Microsoft price development from 2001 to present. I'm going to turn this into a log scale here to make a bit more sense. So basically the price has gone up. Okay, what about Apple? Looks like the price has also gone up. What about, let's say, Ford? Not quite as neat, but also the price has definitely gone up. It's not at its all-time high, but it's higher than it was for decades. What about, let's say, Procter & Gamble? Right? They make a lot of stuff. Look at that. Price has gone up. What about Coca-Cola? Look at that. Price has gone up. What about Pepsi? Are they worse off? No, price has also gone up. What about like the market in general, right? If we look at SPY, that is the top 500 companies in America, price has gone up. And in fact, let's look at the Dow Jones index, which is one of the oldest indices. This goes all the way to 1897. And as you can see, on a large enough time frame, the price basically just goes up. And if we measure this here, right, what we have here, it has gone up by, what is that, 162,000% in admittedly a very long time. But yeah, 162,000% gains. And of course, there have been some bad times here, right? Like this was pretty bad. What's this? A 90% loss, pretty much. Okay. And it took 900 days, oh no, 9,000 days to get back to break even. So here, you're holding for a long time before you get out of your loss. But still, like zoom out far enough, look at any index and most companies you can think of off the top of your head, and you'll see a graph that looks something like this. Prices generally go up. And to be clear, some stocks don't do this. Right? We saw one example of a stock that's like not that great. And some stocks, go down and never come back. Some stocks go to zero. But also it's important to observe that the companies we can think of, like the things, stuff that comes up off the top of your head, are the survivors. Again, those companies are still around. And in general, what we can observe is that the value of assets has been going up. Okay, the value of many, many assets has been going up, and the value of the market in general has been going up. Companies that are already great tend to increase in value over a long enough period of time. So let me clarify something about the term great here. An example of a great company is Apple. And this is regardless of how you feel about Apple products, okay? So in this context, like Apple and Microsoft are both great companies, even though you might prefer one over the other. And it doesn't matter how you feel about their operating systems or whatever. When we talk about great companies in this context, it's like both Microsoft and Apple have a strong business model that clearly works for them. They have loads of customers, their production is working, they keep making profits, and so on and so forth. Right? That's what we mean by a great company. The stuff that they're doing is clearly working, and it's been working for a while. And of course, if we look at something like Apple, we can say, well, how great would it have been to realize the value of Apple like before the launch of the iPhone, right? Somewhere down here, you could have made unbelievable amounts of money. But, at some point let's say in 2015, it was already clear that Apple was a great company. It was already a well-established, great, highly valuable, profitable company. So at some point in 2015, you buy here, you're still making whatever that is, 400% gains, right, over a few years. So you're not taking a huge gamble early on, when it's not clear yet whether Apple can pull itself up again or not. Obviously, there's greater rewards if you do that. But even at the point where it's already clear that Apple is a great company, that things are working out, you can just make a bet on this is going to continue going well. We can also observe, if we look at many different graphs, we can observe that if you invest in multiple great companies, you'll make a profit over a long enough time span, even if some of them go bust. Because as you just saw here, the price of Apple went up and down, so there were periods of time where you would have been in a loss. But if you keep holding on, you quadruple your money over not that much time. So even if there's another company that you're invested in that loses value or even goes to zero, if you invest in multiple great companies and hold on for long enough, overall, you'll still be making a very significant gain. And this is why index funds work so well, right? If you're buying a broad index fund like the S&P 500, you're basically investing in 500 companies that are already great. And yes, some of them will go down in value, some of them will go bust, but overall, this thing is just going to go up in value. And it's basically like betting on the continued advancement of human civilization, right? You're basically saying okay, something really catastrophic would have to happen for this overall to collapse in value in a significant way. This is kind of what we can read out of these graphs. And this is something that was highly popularized by Warren Buffett. Warren Buffett is one of the most successful investors alive today. And he really popularized this type of investing, buy and hold investing, right? So you buy an asset and you just hold on to it. Don't look at the price. It doesn't matter if the price is up or down today. Just buy and hold. And also this idea of buy great companies, this is something he keeps talking about, right? Where it's just that's his strategy, right? His strategy is you look for great companies, you buy them and you just hold on. It doesn't matter if the price is up or down this week or this year or whatever. You're just holding on to these things for decades and betting that overall the price will go up. And this has worked out extremely well for Warren Buffett. Like I said, he's basically outperformed most investors and basically all traders as far as I can tell, right? He has outperformed people by a huge margin with this essentially passive investing strategy. So instead of actively trying to buy and sell all the time, you're just passively buying and holding assets and watching the value increase. And this is really a key insight because it's not that these hedge fund managers we looked at before, it's not that they can't make any money. It's like anyone who's a hedge fund manager or an active trader for any longer period of time is making money. But the thing is, they just generally can't beat the market. They can't make more money than just buying a basket of already great companies and just holding on to it for a really long time. That is what very few people manage to beat, especially taking fees into account, right? Because if you go to a fund where they say are going to actively invest your money for you, then not only are they going to have a really hard time beating the market average, but they're also going to charge you some fees. And after fees, they're basically almost all lose out. So that's where we get to the point where it's 95% of actively managed funds are losing money compared to just buying the S&P 500 and just holding on to it and doing nothing. Okay, especially because they also subtract these fees. So this is the insight that made Warren Buffett one of the richest men in the world. And that has been popularized by him and by literally thousands of videos, articles, books, etc., about investing that have been published since. This is one of the most popular ideas around investing, is to do passive buy and hold investing. Now, having said that, I think this is important to realize, but you shouldn't be afraid to have a play anyway. There is more to learn about investing and more to discover here, and we'll get into that. But even though I think it's extremely important to understand why most people lose money in the markets, and it's important to understand that if you just look at one of these graphs, you're deluding yourself about how you could make money from it. And if you try to actively trade and you try to pick winning and losing stocks and all this kind of stuff, you will probably lose money, or you will not make as much money as if you just do buy and hold passive investing. However, even knowing that, I think it is a good idea to have a play in the markets. And what I mean by that is put $50 in or something like that. Whatever is a small enough amount for you that you don't mind losing it, and just give it a go. Like buy a stock and then sell it and just see what happens, right? Or just buy a stock and hold it for a while and see how you feel as the price goes up and down and stuff like that. I think there is value in just being a participant, in feeling like this is not something that's foreign and for other people and, it's too complicated or too complex, or I'm just going to lose money. Like, don't be afraid of it. And, just for fun, basically, buy a stock of a company you like and see what happens, right? See what happens to your emotions. See what happens when you buy it or sell it, or when you want to buy more or sell or whatever, right? Just observe what happens, but also just learn and experience that you can do this, okay? You can do this. It's a simple enough thing to do. And as long as you keep your risk under control, that's why I'm saying like put in $50 or something, right? Don't start by putting in a huge amount. Put in an amount where you are at no real risk and just have a play with it. Essentially become familiar with this, become a native of this kind of thing. And I think that is an important step in the development as well. And of course, as we go through this class, we're going to go into more here, and we're going to get you to the point where you have a very clearly defined strategy and you know what you're doing. All right, we've talked a lot about potential failure and mistakes to avoid, and why most people lose money when they invest. But now let's talk about solutions. Let's talk about what you can actually do to like outsmart your monkey brain and to make more money the laziest way possible. And we've already gone in that direction, right? We've already gained some insights that show us that kind of a lazy and passive approach to investing is probably actually the best way to do it. So let's talk about this in more practical terms of how to do it. Let's talk about index funds, DCA, dollar cost averaging, and Robo advisors. So let's start with index funds. I've talked about this before, and as I'm sure you know by now, an index fund is basically a basket of stocks that you can buy all at once, where instead of picking individual stocks, you're just saying, hey, I'm going to buy the top 500 stocks in the stock market, and that's it. And an index fund just makes this accessible, because otherwise you'd have to actually buy 500 individual stocks and you'd have to rebalance them and change them out if a company enters or exits the top 500 and whatnot. It'd be very complicated, right? An index fund is basically a fund that does all that for you, and they charge a small fee to do it. So here are some examples of index funds. The SPY, so SPY is the ticker, that's how you search for it. That is the 500 largest US companies on the stock market. There is IWM, that is the Russell 2000, that's basically even larger basket, right? 2,000 largest US companies. There is QQQ, this is the top 100 tech companies. So this is more tech focused and it's a slightly smaller group. This is a fund that has done very well in the past decade or two. There's also the SMI, for example, it's the Swiss market index. So it's like a Swiss version of this kind of thing. And you'll find various index funds. So the most famous ones are all American ones, like SPY, IWM, QQQ, those are all American. But you can also always find, specific like national baskets of funds. So that's another thing you can look into. And like I said, I'm showing here the tickers. You can basically look for these in your brokerage app, and you can also, search for them to find more information on them. And you can buy any of these, right? You can buy and sell essentially shares in these funds through your brokerage app. Now, there's also what I call thesis-based funds. I'm actually not sure if that's the correct term for them. There might be a different term that I'm not familiar with, but let's call them thesis-based funds. And so this is a fund that is less just like broad diversification. It's more like a basket of companies that all share a kind of a thesis. And here's what I mean. So QQQ is actually an example of this, where instead of just overall diversification, you're saying, I think tech, specifically tech companies, are going to go up a lot in value. So I want to buy tech companies specifically, but I don't want to pick individual tech companies. I just want to kind of invest in tech growth at large. That would be triple Q. Other examples of this are, for example, ICLN Or another one is CLNE, I think. These are clean energy indices. So where you just go, okay, I think the future is going to move away from fossil fuels and towards clean renewable energy sources. And I want to invest in that as a whole. That is an example of a thesis-based fund. Another one related to that is FAN, which is wind power companies, all in a basket, and TAN, which is solar power companies or solar energy companies, all bundled together. Then there's ARK funds. ARK is a really popular investment fund. They have different indices that you can invest in as well. So ARK-K is just disruptive innovation, where they're really trying to look at what are things that are really going to change the game technologically in the future. There's ARK-G, which is basically saying genomics is the future of medicine. They're trying to invest in that. There's ARK-Q, which is basically saying robots and AI is the future, and they're trying to invest in that. You get the idea, right? We have loads and loads of different indices, or also exchange-traded funds. That is basically the same thing, right? An exchange-traded fund where you can, on an exchange, so with your brokerage app, you can buy and sell these just like you would buy and sell individual stocks. So it's as simple as that. You can also obviously search for other index funds to learn more about this, but you can simply enter tickers like this in your brokerage app, and you can buy any of these through your app at any time. And the price of these will go up and down corresponding to the value of all the stocks that are inside the index. So that's basically how you do it. But then, of course, the question is, all right, how and when and how much of these do you buy? So let's look into that. So as we've seen, trying to trade and trying to like time the market, right? Trying to get in when the price is low and get out when the price is high and all this kind of stuff is generally futile. It generally backfires, does exactly the opposite of what we're trying to accomplish. So what else can we do? Let's talk about DCA, dollar cost averaging. And DCA has basically kind of become a meme, right? In the investing world on the internet, everybody talks about DCA. And I just want to briefly clarify something, right? The dollar cost averaging meme it's one of these things where the term is technically wrong. So what people talk about when they say dollar cost averaging is technically not actually dollar cost averaging. But it's just, that's what everyone uses it for. And I don't want to go into the technical discussion about this. I just wanted to clarify that, right? It's like people saying literally simply to emphasize something without meaning actually literally, right? So it's just like colloquially, the term is being used for something that's slightly wrong, but never mind. Everybody uses the term the same way, and I'm going to use it the same way as well. So with that said, how does dollar cost averaging work? It's essentially making a plan that goes something like this. I will invest $50 every week, no matter what the current price is. So I pick something, let's say I pick the S&P 500, and I just go every week on the same day at the same time, I'm going to put $50 into this index fund, no matter what the price is, right? If the price is high, it doesn't matter. If the price is low, it doesn't matter. And it averages out, because basically you can think of it like that. If this week the price is high, well, that's good for me because I've been buying every week, so the value of my assets is up, right? That's great. If the price is low this week, then that's also good for me because that means that this week I'm getting more shares for my money. And so overall, if my thesis is simply the price is going to keep going up over a long enough time span, then yeah, if the price is up, it's good. If the price is down, it's good. It doesn't matter. I just buy the same amount every week. And it's called dollar cost averaging because I'm not saying I buy one share every week, where that would be, I would be spending different amounts of money every week. I'm just going to buy the same amount of money for however much that will get me every week. So that's the simple idea, right? That's how we overcome all of these monkey mind problems, all of the, oh my God, should I buy or sell now? Should I do more or less now? No, you just have a simple rule. Every week, the same amount. It can also be every month, the same amount, whatever it is, right? But you just set that rule and stick with it. A quick caveat when it comes to that is we have to talk about fractional shares versus whole shares. So let me just pull up a trading app here to give you an example of this. So here we're looking at Apple shares. And here's the thing. In many traditional, so it used to be that you can only buy entire shares, but it's become more common now that you can buy fractional shares. And here's what that means. So right now we're looking at Apple and the price is $145. Now, if let's say I want to buy $50 of Apple shares every week, right? That's my plan. If I go to buy, so the problem is, of course, if I want to, if I want to buy one here, it's very generous assuming that I want to buy 100 right away. If I want to buy one share here, then I have to have $145. So if I have $50 a week to allocate, I actually can't make this purchase. And in this case, I would basically have to wait for 3 weeks or wait for the price to come down. Basically, I would have to like save up my DCA amount until I can buy at least one full share. And like I say, this is how it used to be. It used to be normal that you can only buy entire shares. But now what you can do, and what you can do in this app here, this is Interactive Brokers, and that's just an example. What I can do here is I can change this from shares to US dollars, and I can basically say I would like to buy $50 worth of this, and it tells me that's an estimate of 0.34 shares. And it lets me do that. It lets me submit a buy order for 0.34 shares. So if you have fractional shares trading available, then you can do like perfect or clean dollar cost averaging. And otherwise, you might have to, like I said, kind of put those $50 or whatever it is on hold until you can buy a full share, which is not quite as ideal. Having said that, this is, like I said, more common now that you can buy fractional shares. And also, this is a stocks problem generally. You can always buy fractions of crypto. So if we're talking about Bitcoin, ETH, and so on, you can always buy fractions of that, no problem. So their dollar cost averaging is easier. We also have a calculator for this. So here's an example where you can calculate what this would look like, right? So let's say we do 100 per month. So every month we put in $100 into, again, I'm just going with Apple here because that's pre-selected. And let's say we start doing this in 2015 and we can calculate the returns on that. And here we go. So this tells us that if we put in 100 per month, starting in 2015 into Apple shares, our total investment is $7,200 that we've put in, and the total value by now would be $25,500. And so here you can also play around with this with some of these different ticker symbols that we've looked at, just to get an idea of the kinds of results you can get with dollar cost averaging. And you can also do this with crypto, of course. So let's just go with Bitcoin here. So here, if we put in 100 per month, same thing, right? We start in 2018, okay, January 2018, why not? And we calculate that. So this is what it would look like. This is how the Bitcoin price has developed over this time span. And here we can see over 3 years, we would have put in a total of $4,400 by DCAing $100 every month. And we would currently have $17,000 worth of Bitcoin. So this is also something you can play around with if you want to get a better sense of what DCAing would actually do. And we can basically backtest a couple of different DCA approaches. Now, knowing this, let's look at one more thing that's really good to know about, which is robo-advisors. Robo-advisors are taking this idea of passive investing even further. It is kind of taking this buy and hold, DCA, don't worry about the price, passive investing idea, the Warren Buffett approach, as far as possible. So what is a robo-advisor? Well, a robo-advisor, an example of this is Wealthfront. Wealthfront have a robo-advising product, essentially, where it essentially does all of the things for you that it tries to make this kind of passive DCA investing strategy as easy as possible. And here on their page, we can see some of this, right? They talk about how we'll handle the trades, keeping you diversified. We do tax loss harvesting, and we only have 0.25% in fees. So if you want to follow this kind of passive investing perfectly, what you'd want to do is you'd want to be DCAing in, and you would want to rebalance your portfolio every once in a while, and you want to do something like tax loss harvesting. That is depending on where you live and the tax laws and so on. But there's basically some things that a good financial advisor would still do for you, even if you have an almost totally hands-off approach to investing. And instead of paying a person to do that, A robo-advisor is basically saying, look, we just automate all of these little processes to squeeze just a little more benefit out of your passive investing. And we do that automatically for a very low fee. So a robo-advisor tries to be just slightly more optimal than you just investing in index funds. It tries to give you an optimal diversification of maybe different index funds and things like that, but also manages your portfolio in such a way that you make no decisions. You never have to make a decision. You don't even have to think about what index fund am I going to buy. So it tries to make that even easier and essentially even more passive. Another example of a robo-advisor is Betterment. They also have this auto investing product. That's the same kind of thing. And both of these are American. I think in America, you have probably the widest range of robo-advisors available, but you also have them in other countries. Here's one from Switzerland, True Wealth. It's the exact same idea, okay? And you can very likely, no matter where you live, you can very likely find a robo-advisor in your country. And you'll maybe have to do a bit of searching to find out which one you want to go with. But this is essentially even more passive investing, even less direct involvement and decision-making on your side. The idea with a robo-advisor is always low fees, as low as possible, automation, and essentially just some diversified portfolio of index funds. That is what they offer, and try to make it as easy as possible. So that is also a useful thing to look at and think about. Do you want to be putting your money into index funds yourself? Using a brokerage app? Do you maybe want to buy some individual companies, Warren Buffett style, pick some companies that you think are great and hold them for 20 years or something like that? Or do you want to just leave it all to an automated system? So this is where we're at now. And at this point, you have enough knowledge to start making decisions, although we have more lessons, so there is more to go through. But basically, the further you go through this class, the better informed you are, the better decisions you can make. So right now, the important takeaway is that it's about making a plan and sticking with it. Because otherwise, your monkey mind interferes. And fear comes up when the price is down and it makes you want to sell at a loss. And FOMO kicks in when the price goes up and it makes you want to double down close to the peak and all this kind of stuff, right? So having a system where you just say, no, it doesn't matter. It doesn't matter what the price is doing. I just have this plan and I'm sticking to this plan. And investing for the long term, dollar cost averaging instead of trying to time the market. The decision to make is to allocate a portion of your savings or your personal runway. Because initially we were talking about simply building up that personal runway in cash savings. And now you can get to the point where you want to decide, okay, at what point do I say I have enough of a personal runway and I want to put my extra income, instead of putting it into savings, putting it into investments, okay? And maybe that's a certain portion. Maybe you say, okay, I want to have a 6-month runway and all the money I have beyond that, I want to put into investments. Or maybe you want to have an allocation. Maybe you want to have 50% runway, 50% investment, or whatever it is. And what you want to do is figure out your risk profile. I'll also have more lessons here to help you do that, but right away, this is how to think about it, right? It's like, look, if you're holding cash, that is less risk than investing in companies. And investing in index funds is less risk than investing in specific individual companies. And investing in stocks is probably less risk than investing in crypto and so on, right? You basically have to think about, well, how much am I willing to lose here? How much of my money am I willing to risk? And come up with an allocation that makes sense for you. And once again, what I encourage you here is to have a play with this. I think there's great value in being an active player, an active participant in a system like this. Instead of this financial stuff being foreign or being scary, have a play with this. Like I said before, go ahead and buy a stock and see what happens, right? Don't expect that you will have the perfect plan from day one and you will then perfectly execute and have a non-stop winning streak. Nothing in life works like that. So what I'm trying to do here is I'm trying to arm you with knowledge that I have found extremely useful, that has helped me a lot. But it's also important to realize that I don't have a perfect record of only making good financial decisions, right? That's just not how it works. It's like you play the game, and if you play the game well, you get better over time. You make mistakes and you learn from those mistakes. So I want to encourage you to again, with a small amount, something that doesn't ruin you, basically something that doesn't bother you even if you lose it, like jump in, buy a stock, buy some Bitcoin, see what happens. And as you go through this class, you'll keep learning more and you will refine your strategy over time. Should you invest in real estate? Let's talk about this specific investment vehicle. And this is an interesting one because it is probably the world's most popular investment. And it's certainly one of the most talked about. It's also like one of the most talked about in mainstream media. And so there is a lot going around. There's a lot of information and a lot of stories going around about real estate investing. And it's also kind of the most, I think, culturally ingrained. So even if, for example, in your social circle or in your family, there's generally no talk about finance and investing, you've probably still heard stories about real estate, and you've probably still been told that real estate is a great investment and that is where you should put your money. It's also probably the one thing that people most readily take on loads and loads of debt to buy is a home. So let's examine this a little bit, because I think because there's so much information about it, there's also lots and lots of misinformation, loads of myths about it. And what I want to do primarily here is to just bring a bit more clarity to this. Again, this is not about my opinion on real estate. This is about what I think you should know about real estate to decide whether you want to invest and how much to allocate. I also want to say, as a disclaimer, I personally don't have a lot invested in real estate, not zero, but not a lot. And I want to disclaim this because this is not my area of expertise. Out of all the different investment vehicles, this is one of them that I know less about and have less experience in, so take it with a grain of salt. Now, when it comes to real estate, you've probably been told something like this. You've probably been told that a home is always a good investment and that prices always go up. And if you imagine asking your family, hey, should I put like hundreds of thousands of dollars into X? I can imagine that if X is a house, right? If you say, hey, should I put hundreds of thousands of dollars into a house? People will probably go, yeah, that's probably a good idea. Why not? Go to the bank, see if you can get a loan. If it's anything else, people will be like, are you crazy? What do you think you're doing? And that's an interesting dynamic, isn't it? And the thing is, if I'm going to say anything controversial here, it's basically this. My take on real estate is that real estate is not an exception. And this is where I think I disagree with the mainstream narrative, and where basically this is why my perspective on this is different. To me, real estate is just an investment vehicle like any other. And so the same rules apply. Okay, I evaluate it as an investment as I would any other. What is definitely true about real estate is that it is a historically well-performing asset. It's certainly not the only one, but it is a historically well-performing asset. And so lots of people have made the experience of buying a home and seeing the price of that increase by a lot. So here's a graph that goes all the way back to 1953 and all the way up to 2021, or actually 51 to 2021. And you can see here the median home price, and this is in the United States, and it goes from under $25,000 in 53 to over $300,000 in the present. And of course, that is a huge increase. So a lot of people have made this experience where they buy a home, and it is kind of just a reasonable decision to make, right? You buy a home, and the value of that home goes up by a lot in their lifetime. And because a house is primarily something you live in and it's an illiquid asset, people are not constantly buying and selling homes. They're not trading in and out of it. It's an asset that's very easy to hold for the long term. And because of that, lots and lots of people have experienced this benefit of long-term passive buy and hold investing with their home and with nothing else. And that is a big reason why we have this story around how great of an investment real estate is. An interesting thing about this graph, though, too, is that it also shows us the inflation-adjusted value, in which case the price has still gone up. And especially if we consider, if we look at like 1990, let's say, from here, prices flap for a while, then it goes up sharply. And then even though there is a very serious crash, that's the 2008 crash, not that long later, prices are higher again than before the crash. So here, this can show you that, even if you got in on the housing market not that long ago and you experienced the crash, housing prices are back up to a higher value once again. And that is true even adjusted for inflation. So that's kind of crazy. But at the same time, it also shows that if we take inflation into account, it's actually not that exciting. It's still pretty exciting. Still definitely value accrual, but it's not that exciting. But, nobody thinks about inflation. All you know is, oh, back in my day, I bought this house for $50,000 and now it's $500,000. That's a lot, right? It's a lot of increase. Nobody takes inflation into their calculation. Okay, so we have that. Now, like I said, to me, it's an investment like any other. It has historically performed very well, as have many other assets, but that doesn't necessarily mean that it's guaranteed to continue going up forever. In fact, there is a problem with the very idea of it going up forever, because at some point, who's going to buy these houses? Right? If the price of houses has gone up 10x in the last, 50 years, and now you're paying $500,000 for a one-family home, you can't really expect that 50 years from now, people are going to buy, 10x that, $5 million for a one-family home. Who's going to be buying this house? That's basically only possible if the dollar gets devalued so much that most people can afford a $5 million home. So that's another problem with this story. But another thing is that I think that the most important thing to understand is that the real difference is social perception. The difference between other investments and real estate investments is that investing in real estate is a socially completely accepted thing to do. And it kind of reminds me of this Gordon Ramsay meme, where if you buy a home and you take on you take on a mortgage, buy a home, and things go wrong, and you lose your home because the market collapses or whatever. You go, I lost my money in the housing market. Everyone's, oh, that's just so sad. Poor you. It really wasn't your fault. You didn't do anything wrong. If you lose the same amount of money anywhere else, if you say, well, I bought some stocks, I bought some crypto, and I lost my money, it's like, what do you think you were doing? That's stupid. Like, of course you were going to lose your money. It's all a scam, etc., right? But it's the same thing. I mean, you bought an asset. You thought the price would go up. It didn't. Things went wrong. But socially, it could make you an outcast if you lose your money on anything other than housing. This is one of those things that I think is incredibly valuable to understand about investing. Like, never underestimate how much of human behavior is dictated by social dynamics such as that, such as how will people react if. And it's only backwards rationalized. Of course, no one will say, well, I bought a home because that's the most socially acceptable way, to invest, and that's the only thing that people kind of socially will let me spend all this money on or go into so much debt for. Like, nobody says that. They will rationalize it and say, oh, it was a great investment. I really thought about it and I made the right decision, But the real reason is a social one. Okay, so that's one thing that I think is valuable to understand about real estate. And let's take a look at some other things that are generally left out of this narrative of buying a home is always a good idea, home prices always go up, etc., right? This story, we have like this cultural story that's very, very simple, that is oft repeated, both in social, just like in social interactions, as well as the mainstream media kind of likes to beat this drum too. So let's look at some of the things that are like left out from this story. So if real estate investments are indeed no different from any other investment, what's the first question we need to ask? Remember, the first question is, where does the money come from? If I'm going to buy this asset, whatever it is, and then in the future I'm going to get a lot more money out of it, where does that extra money come from? So let's think about this when it comes to real estate. What makes a house valuable? Well, one thing is the utility of a house, right? It is where you live. It is shelter. It is storage for all your stuff. It is where you're connected to electricity and water and so on. Like the utility of having a home is, of course, very valuable. But does that utility increase over time? So right now, in a house, I can live, I have electricity, and so on and so forth. 10 years from now, has that increased? Is there something about it that has increased that utility of the house? Usually, the answer is no. Another factor is the scarcity. So a scarce asset tends to be valuable. And what's scarce about a home is location. So if I have a house here that I live in, then you can't also have a house here that you live in because I'm taking up this space and the space is scarce. And this is where some value accrual comes in. And in fact, this is also where the utility can increase over time. That's the kind of thing where you buy a home that is relatively cheap because it's away from the city center, but then over time, the city creeps outwards and the center forms around here. So now there's, bus stops and tram stops and there's a supermarket and there's all kinds of other stuff that wasn't here before. And so now the utility of living here is essentially better than it used to be. Because it used to be that you were far away from the center and you had to go far to, do your groceries and get to your office and whatnot. And now all of that stuff is suddenly close by. So that is one of the places where value accrual can come from. And there's another factor here, which is value accrual comes from the fact that the next person is going to pay more for it. And isn't that what's often being talked about? Basically, the price goes up. You buy it now, you wait for a while, and then the next person will give you more money for this than you paid. And isn't it interesting? Because then we talk about this, and that's what's called speculative investing. Like you buy something just because you think some greater fool is going to come along and give you more money than you spent on it. It's like, everyone in the mainstream media talking about how this is what you should be doing is like, let's not think about that too much, right? Because speculative investing is the bad thing that we always tell people not to do. So let's not think too hard about how much of house buying and how much of the story about house buying is really just speculation. Another point that I think is often left out of the discussion, again, you just look at the graph, oh my God, look at how much house prices have gone up. It's like, well, costs. Okay, there's running costs to a home. There is upkeep and renovations that you have to do. Basically, the longer you hold it, the more of your money is going to be spent on this. And also, in order to maintain the utility of a home, you do have to keep up, which is to say that there's maybe new building standards, there's new technology and so on, where if you just buy a home and just hold on to it for 30 years, do nothing, one of the things that's going to make it a lot less attractive is that by then it will have this really old, outdated kitchen and, newer buildings have better insulation and have just better everything, essentially. And by comparison, your 30-year-old unrenovated home doesn't look very attractive. And so at that point, maybe you can hope that the location, the land has increased so much in value that someone's willing to take this off your hands at a high price, knock down the old building, build a new one or something like that. And it's just important to keep in mind, again, this stuff, it's not just static. Another thing here is property tax, wealth tax, sales tax. It depends on where you live. Obviously, different jurisdictions have different rules here. But if you take all of this stuff into account, if you take into account all of these costs, if you take into account what you pay in various taxes along the way, and you take into account inflation, how much have you really gained by the end of it? And most people just don't consider this, or usually the conversation doesn't include a lot of these considerations. And an important takeaway here is that value accrual of a home depends on many factors. Okay, it doesn't just happen by itself. And you can, of course, like with any investment, depending on where you buy, depending on what you buy, depending on what price you buy, maybe it turns out to be a great investment because value increases a lot. Maybe it turns out to be a terrible investment. It's just not as safe or as guaranteed as people love to make it out to be. And then there's another thing. There's another really important thing about investing in real estate and taking on debt for real estate. So let's simply think about this. You did this, right? You bought a home, and some years, some decades later, you sell the home and you sell it. Congratulations, you've sold it for way more money than you originally paid. That is excellent. Well done. You've made so much money. Except, hold on, right now, you don't have a place to live anymore. And so you probably have to use that money you just made to, I don't know, buy a home. And let's see, maybe you bought your home for $100,000 and now you sold it for $300,000, and that's a massive gain. And now you're looking around for, a house kind of similar to the one you had. What does it cost? It costs about $300,000, doesn't it? Because guess what? It's not just your home that went up in value. It is housing in general that went up in value. And if you don't want to downgrade, then you'll have to spend all the money you just made. In fact, you might have to downgrade anyway because you just spent all this money on, property tax, sales tax, whatever tax, right? So this is an important thing to consider because value is relative. Like, of course, the number goes up when you ask the question, how many dollars is your house worth? But if you have the one house you live in and you sell it and then you want a new house to live in, the question is, well, how many houses is your house worth? And generally, the answer is one, right? This house is worth as much as this kind of house in this kind of location. And so because of that, your first house, your first home is not that great of an investment. Now, one thing I haven't mentioned yet that you're maybe thinking is, hold on, what about rental income? And this is a different story. Because if, of course, you own real estate, you have a house that you live in, but you also own real estate that you hold as an investment or that you rent out and then you have rental income, well, that's a different story. That's a different story. And then it becomes a real investment because at that point, if that's the kind of thing you're thinking of, like, okay, I'm going to rent out, maybe I'm going to buy an apartment block and rent out these apartments, or maybe I'm going to do something like short-term rental, build something that you put on Airbnb, all this kind of stuff. Well, at this point, it should be a business, right? You should have a business where the goal of this business is to build an efficient machine that does all the processes necessary for all this rental and maintenance and upkeep and so on and so forth, handling bookings and so on for short-term rental, that all does all that and still makes a profit. But that's not what most people do, and it's not what most people think about when they talk about this kind of every man's investment of real estate, because most people buy the one home they live in, and perhaps they buy the one home and then also a holiday home or something, but it's also for them. And it's only when you have multiple homes and you can sell some of them or you can earn rental income from some of them without having to compromise the place you live in, that it really becomes more of a serious investment vehicle. So with this, here are some of my controversial takes on real estate. And as always, I invite you to disagree with me and I invite you to do your own thinking on this and to start discussions on this. But here are my takes on this, right? So first of all, housing is not a magical exception to other assets. Just like other assets, it fluctuates in value. Just like other assets, whether the value goes up or not depends on many, many variables. Number two, your first house is not that great of an investment, right? So buying a home that you live in, whether the number goes up or not, you can then sell it and then you have to buy another home. It's just not that great of a deal. And while we're at it, let's add to this, past results do not indicate future returns, which is also just true for all investments. So yes, housing prices historically have gone up a lot. That doesn't mean they're going to keep going up forever. And with all this, let me clarify that I'm not saying that real estate is a bad investment. Maybe I'm saying that real estate is an overrated investment, but really it just comes down to this. I think that there's a cultural narrative around real estate that is easily misleading and that can lead you to make the wrong decisions for the wrong reasons. And all I'm saying is, like, consider this carefully and treat it as any other investment to make a really clear, rational, deliberate decision about how you want to allocate. And speaking of which, let me give you one piece of advice here that I found very useful, which is, or it's not even advice, it's something you need to know about, is real estate investment trusts. So a real estate investment trust is essentially a fund, and you can find these as exchange-traded funds. So with your brokerage apps, you can buy and sell them, that essentially bundles together real estate. And this helps overcome one of the major issues of real estate investing, which is that it takes a lot of money to get in. So if you, especially if we're talking about real estate as a real investment, so we're not just talking about buying the home that you live in, if you're looking at getting into the real estate game and buying real estate as real investment vehicles, then the problem is, well, you have to have at least enough money to buy the one home in addition to where you live, or you have to, go to a bank, get a loan of that amount and so on. It's basically a barrier of entry to get that much money all at once. Well, with a real estate investment trust, what you basically have is you have a very easy way for investors to pool their money into essentially one single company that then spends that money on real estate projects and that takes the profits from those real estate projects and distributes it back to the investors. And the easiest way to get in, so the easiest way to start making gains from real estate price appreciation is to put money into real estate investment trusts. And because there again, you can, especially if your app allows you to do fractional share buying, you can put in $10, right? You can start with $10. This is available in many different flavors. And also, by the way, this might be called something different, in different countries. It might not be called a real estate investment trust, but you can look this up to see what kinds of exchange traded real estate investment vehicles are available. And of course, as always, you have to do your own due diligence. You have to figure out, okay, what exactly am I investing in? What is being bundled together in this investment? How are they paying dividends and whatnot? And there's absolutely no guarantee that this works out. But if you are a strong believer in the real estate market and in this investment vehicle, this is how you can start gaining from that, how you can start getting in without having to actually buy an entire building. So those are the things that I think are useful to know about real estate. And I hope that with these ideas, you can think of it as one of the possible investment opportunities, and you can make a good decision about whether you want to get in, and if you get in, how much you want to allocate and how you want to do that. It's time to talk about cryptocurrency. Should you invest in cryptocurrency? Now, cryptocurrency is a great thing to invest in for people who want to feel like a genius for about 2 weeks out of every 4 years and like an idiot for the rest of the time. So here's a relatively long-term graph of the price development of Bitcoin. As you can see, if you invest in Bitcoin about every 4 years, there's a huge spike in price that makes you feel like you're a total genius, and that makes you go, oh my God, I'm going to be rich soon, and start picking out the color for your Lambo. And then shortly after, the price dips and you're embarrassed and you don't talk about cryptocurrency anymore. Let's switch over into the live graph here, because just to clarify something about what we're looking at here, this is the price development here since 2013. And this is on a logarithmic scale. This pricing scale here goes from $6 all the way to $60,000. If we turn this into a regular scale, you can see why indeed you feel like a genius during those brief moments. These spikes in price are so big that basically the latest one is so high that on a regular scale, you can't even see the earlier price spikes anymore. So it really is a wild ride. Prices in cryptocurrency are extremely volatile. And that is basically both the advantage and the disadvantage of this space. So let's, as we usually do, try to figure out what is this as an investment vehicle and what do we need to know to make better decisions about it and make decisions about whether we should invest, how much we should invest, and so on. And I think one of the most important things to know is related to this article here that I have posted, which is an article from the year 2000. From a newspaper which says, internet may just be a passing fad as millions give up on it. And of course, now in retrospect, we can see that that's ridiculous. But it's a good reminder that at one point in time, not that long ago, the internet was this strange foreign thing that, like geeks and some young people were into. But a lot of people were convinced that nobody is ever going to make a purchase on the internet. Nobody's ever going to trust a website with their credit card details or something like that, right? And people who were saying, no, this is actually going to take over the world were ridiculed. And it's also important to note that this is the year 2000. The internet as a technology had been around for a long time already. But from the mainstream and consumer perspective, it was still this kind of strange foreign thing where we weren't sure if it was going to stick around or not. Blockchain technology is definitely still in this phase. It is in this phase where some geeks and some young people are very excited about it and they're talking about how it's going to be the future of everything. But most people are like, I don't know what you're talking about, and I think it's a scam and all this kind of thing, right? That's important to understand. There is both opportunity and risk in that. And also, even if it's true that blockchain is in this phase, it doesn't mean that it's going to retrace the rest of the history of how the internet took over the world. Right? There are early stage technologies that look very promising and then they die. But before we go any further than that, let's get into some of the terminology and some of the background here, because I've already mentioned several things like Bitcoin and crypto or cryptocurrency or blockchain. And what the hell is all this stuff? So let's have a bit of a crash course and see what we need to know, because as always, we don't want to be investing in something we don't understand, right? If someone tells you, hey, you should buy Bitcoin, that is not a great reason to make an investment. We definitely need to understand more about what we're talking about. So let me try and provide a crash course, and I will keep this as short as possible while also providing what I think is the most important stuff you need to know to get started. Let's start with Bitcoin, because that is indeed where it all starts. So Bitcoin was created in 2009 in response to the financial crisis. So in 2007, 2008, there was this huge housing market crash that led to a basically global recession. And it was something that made a lot of people pretty angry, because maybe for the first time, or for the first time in a long time, it was obvious how basically greed and fraud had enriched very few people at the cost of everyone else. And Bitcoin was directly a response to this problem. It's a cryptocurrency because Bitcoin itself was initially proposed as a currency, and it can be used as a currency, which is to say that it's a digital currency. You can have a digital wallet, and you can send and receive Bitcoin just like you would send and receive money using PayPal, or like you would hand over cash and receive cash. It's that kind of thing, but in a digital form. And it has all the properties that a currency needs to work as a currency. So even though it's digital, it is something where you can trust. If someone sends you a Bitcoin, you can trust that this is the real deal, that this isn't, someone can't just copy paste or produce Bitcoins out of thin air or something like that. And the most important thing here is that it is a peer-to-peer, trustless, permissionless, decentralized technology, which means that it is basically a network. It's a peer-to-peer network. There isn't a central, a Bitcoin company that's responsible for Bitcoin. There isn't a central server where all the Bitcoin information is stored or anything like that. It is all decentralized across the globe, and there's essentially no CEO, no leader, no boss in the middle, and that is really important. Trustlessness and permissionlessness also mean that you basically don't have to trust an institution. So like with a bank, if they tell you this is how much money you have in your account and you can withdraw it at any time, you basically have to trust them. And if the bank is in trouble, and if the bank goes bust, you have to trust that the government will have your back, or maybe the bank is insured or something else. But you have to trust these institutions when they tell you that you can access this money somehow. With Bitcoin, that's not the case. You don't have to trust anyone. You only have to trust the code. So if you understand the code, it is completely trustless. And permissionless means you don't have to jump through a bunch of hoops. It's not like with a bank where you have to sign up and give your ID and fill out forms and all this kind of stuff. It is completely permissionless. Anyone, anywhere can use Bitcoin. This makes Bitcoin fully self-sovereign money. And this is really what's amazing about it. Regardless of how you feel about Bitcoin, regardless of whether you think this is great, or whether it's the future or a scam or whatever, regardless of whether you want to buy Bitcoin or not yourself, the technology behind this, the idea behind this really is genius, and it was groundbreaking at the time. It basically means that you can have money that no bank and no nation and no institution, no centralized power anywhere in the world can interfere with. And they try, right? Bitcoin has been banned and regulated and all kinds of stuff many times over since 2009. But one thing that's not happened is it hasn't gone away. There is no central power in the world that can prevent people from using Bitcoin if they want to. And this is the connection to the 2008 financial crisis, where we could see that all this power and all this wealth is concentrated in the hands of very few players who don't have the general public's best interest in mind. And they can make the rules to protect themselves, and they can screw over everyone else. And as long as we concentrate power and wealth among the very few, this is a problem we'll have. And Bitcoin solves this problem, or at least it proposes a solution to this problem. And this is where we come to another term that I've used before. The technology behind this is called blockchain technology. So the technology that makes this possible is blockchain technology. And lots of other projects are built on blockchain technology, but Bitcoin was the first. Blockchain technology is something that enables nation-state level security without a nation state. So you can have a financial system that is as secure as a nation-state system that's essentially backed up by the nation's power, the nation's military, and so on. You can have that without a nation state. And it also means that you can have banking without banks, and perhaps even governance, without government, and perhaps much more to come. These are all things that have evolved out of this technology of blockchain since 2009. So that is Bitcoin. That's the origin story of blockchain and cryptocurrency. And another thing that's key to Bitcoin and to the appeal of Bitcoin is that the supply of Bitcoin is capped at 21 million BTC. So BTC is the ticker essentially for Bitcoin. The supply is capped at 21 million. So the maximum amount of Bitcoin that will ever exist in the world is 21 million. And no central bank or government or entity can print more BTC ever. There's just no way to do this. And this is another thing where instead of having central authority that can control the money, and if they're in trouble, they can just print money and bail out the banks who've screwed up and things like that. And they can basically, which is again, basically enabling and empowering the few who are already in power, who are already wealthy, by giving them money that you've just printed at the disadvantage of everyone else, because everyone else will suffer the inflation from increased money supply. With Bitcoin, you have a hard cap on the total supply, and that is also something that drives the value. So you can easily imagine, right, if there's only ever going to be 21 million Bitcoin, if the entire world wanted to start using Bitcoin, that would drive up the price massively, because each individual could only ever have a small fraction of a Bitcoin at most if everyone in the world wants some of it. So this is the one big cryptocurrency that started it all. There are a couple of others and a couple of other concepts that I think are useful to know about. The next one to talk about would be Ethereum. Ethereum essentially takes the idea of blockchain technology and of this decentralized peer-to-peer permissionless nature of it, and basically says, okay, instead of using this only for currency, what if we use it for everything else other than currency? Or in other words, if we have this technology, what else can we do with it? And Ethereum is essentially a platform that enables people to create everything else on this kind of technology, including currency. You can have currency, you can use Ethereum as a currency too, but that's not its main point. So Ethereum is basically a decentralized application platform. And currently, it's primarily used for various financial applications, although it's capable of doing many other things. That is its primary use right now. And what's happening is on Ethereum, this kind of ecosystem of money Legos is being built on what's called smart contracts. So a smart contract is essentially code where instead of using, let's say, lawyers to draft a contract and make a deal, you have code, you have your contract in code. And if both parties agree with that contract, you can have this kind of trustless execution of some kind of an interaction. And this, like I said, is currently mostly happening with financial applications. You have all kinds of financial applications that, like money Legos, can interact with each other. And a lot of interesting stuff is happening in this space. Ethereum is the basis for decentralized finance, which is essentially banking without banks. And we'll talk a bit more about that later. Ethereum is also the basis for NFTs, which is basically unique digital art. So you can have a single owner of a digital piece of art or of a collector's item or something like that. And that is something that's also taken off in recent years. Another very important concept to know about in the cryptocurrency world is the concept of stablecoins. So like we've seen, the price of Bitcoin is extremely volatile. It spikes up to the extreme at times and then crashes down. It has had greater than 80% crashes in value multiple times in its lifespan. Extremely volatile currency. And the same is true for Ethereum and many, many other coins in the cryptocurrency space. But there are also stable coins. And stable coins are coins like DAI, USDC, USDT, and so on and so forth. And there's also stable coins for other currencies. So synthetic euros, GBT, CHT, and so on and so forth. For basically pretty much any strong currency in the world, you can find one or several stable coins. Now, what is a stable coin? It's basically a cryptocurrency that is pegged to fiat money. Fiat money is central bank money. So you can have a digital currency, let's say a DAI, which is pegged to a US dollar. So one DAI is always going to be roughly $1. It will fluctuate in very, very small amounts, but roughly one DAI is always going to be $1. But it has all the other properties of cryptocurrency. So it's peer-to-peer, it's decentralized, it's permissionless, etc., etc. And you can spend it and receive it using digital wallets. This is important because the extreme volatility of something like Bitcoin might be attractive to traders who want to try and get some gain out of this, but for the average everyday user, it's not really very useful if from one moment to the next you don't know how much money you have because the value changes so much. But you can actually benefit from stuff that's happening in the cryptocurrency world without being exposed to this crazy volatility. You can essentially convert your fiat dollars or your fiat euros into a cryptocurrency digital equivalent. And so you can be exposed to this space and you can play in the cryptocurrency world with essentially normal money that holds its value with relative stability. Stablecoins are important to know about because these may become the backbone for cryptocurrency adoption and blockchain technology adoption. Like I said, most people won't want to deal with wildly violent price swings, but if there are benefits to having crypto dollars, and it's basically just as easy to use as regular dollars, right? If you have an app that's just as easy to use as your Venmo or PayPal or whatever, but it just happens to use crypto dollars, then why not? That is something that could open up the floodgates to mass adoption. And then one more important currency to know about is Dogecoin. Dogecoin is like Bitcoin, it's basically a copy of Bitcoin, but with a funny dog meme. And Dogecoin could have literally made you a billionaire. Right? If a few years ago, you'd have told yourself, you know what, this Bitcoin copy with a funny dog meme, this is where I should put my money, and you would have held, then you'd be very, very rich right now, okay? And so crypto can be pretty weird like that. And I'm only half joking about this. It is important to understand Dogecoin because like the power of just meme coins and silly coins, like that is a significant force in the crypto world, as strange as it is, right? And in case you're wondering, how much Dogecoin did I buy many years ago? Well, none, zero, right? I've never owned Dogecoin. And I'm not mad about it. You know, I'm totally at peace with my financial decisions around this. And don't you dare say otherwise. Although, again, in all seriousness, what happens a lot in crypto is that some crazy meme coin will have a price spike that just makes your head spin, that makes you go, oh my God, I could have been so rich. But if you're trying to chase those, if you're trying to chase the latest meme coin, that's basically gambling, and it is a shortcut to financial ruin. But it's important to know that this kind of stuff is happening. So there is a lot to say about the technology behind these things, and I could make an entire course about this. Many books have been written about this, right? This is something you could spend your life studying, but I don't want to go any further than this for now. Let's focus on what we need to know about this as an investment vehicle. I can't hope to provide a really comprehensive view here in a short course like this, but let's look at some of the basics that will help you make better decisions. So first of all, let's just make a distinction. Crypto assets in easy mode and crypto assets in hard mode. First, easy mode. This is what I recommend most people do. And here's what I recommend you do. Number one, spend a few hours doing your research on this. Learn about Bitcoin, learn about the technology until you have a sense of what is going on here. Certainly beyond what I can explain in a few minutes in this video. And learn enough that you can decide, okay, this is something where I do want to dip my toes into this, or nah, it's not for me, I just want to be out. If you decide that you want to be in and you want to invest in cryptocurrency, sign up with an established, trusted, centralized cryptocurrency exchange. And then DCA, dollar cost average, a set amount every week or every month. And only buy Bitcoin and Ethereum. Only buy BTC and ETH and ignore all the other coins. If you simply sign up for a trusted exchange, you DCA in your whatever $10 a week or $200 a month, whatever fits your budget and your allocation, and you only put it into these two assets, that is a pretty good bet for the long term. So what are these exchanges? So there's loads and loads of cryptocurrency exchanges. And, historically, many of them have been dangerous because it was unclear whether they would stay around or whether they would just run off with your money and so on. But, it's been around long enough that I think now we can look at exchanges like Coinbase, we can look at exchanges like Gemini and Others to mention would be Kraken and FTX. And these, I would say, are trusted exchanges where you don't have to worry that they'll suddenly go bust or that they'll run away with your money or anything like that. I recommend, for easy mode, I recommend Coinbase and Gemini primarily. Those will have the most user-friendly interfaces, easiest to use. They've both been around for a really long time. I also like Kraken and Bitstamp, and FTX is great, especially for trading and stuff like that, but I wouldn't even go there. Basically, Coinbase, Gemini, unless you have a strong reason to use something else. But use like the most trusted, the biggest, the most established exchanges and keep it simple. By doing this in easy mode, you essentially join in on the price movements of Bitcoin and Ethereum without self-custody. So you're basically not a true user of cryptocurrency because you're not using it in a self-sovereign way. You're signing up with one of these exchanges, which is like a brokerage or like a crypto bank, and they will do their KYC. They will ask for your identification and all this kind of stuff, right? They will go through that kind of process. And then you can buy cryptocurrency with your card or with bank transfers or something like that. And you will keep your cryptocurrency in that exchange, at least initially. At some point later, you might decide to go to self-custody. But to begin, your crypto is just sitting in Coinbase or in Gemini, and you basically trust them, right? You trust them that they will secure it and hold on to it. This doesn't give you all the decentralized, peer-to-peer, trustless, etc., of cryptocurrency, but I think it is a good place to start. So there you go. That is my recommendation. This is what I would say most people should do, or most people should start here in easy mode. Much of the crypto space is still complicated and opaque and relatively inaccessible. And this is why I'm talking about easy mode and hard mode, right? What we're seeing here is this is the easiest, most accessible way to get in. And a lot of it is more complicated than I can even summarize in a video like this. And there's opportunity in that, but there's also risk in that. And easy mode is about waiting until all this complicated stuff kind of gets sorted out and until the easier, more accessible user interfaces and programs come along. You can think of it like this, right? Above is a picture of a command line OS, a command line operating system. And early computers, this is how you interacted with them, right? You were staring at like blinking cursors on green text and typing in commands in order to interact with the computer. And of course, that was difficult to learn and difficult to understand. And at that point in time, there was great opportunity in being one of the early users, in understanding how to use computers. And people who built businesses on their understanding of computers at that early time generally made a lot of money. But there was also downside of basically having to deal with all this complexity, and also having to take on the risk of interacting with something, building skills and building businesses in a space that may or may not still be around 10 years from now. Much, much later, as the space developed, you started getting easier and easier user interfaces. And the pinnacle of this is probably the iPad, right? The iPad is this simple, friendly device with colorful icons that basically anyone can use. A toddler can use it, your grandma can use it. And eventually, if crypto survives, this is what will happen. We will have people using cryptocurrency without ever thinking about the code behind it, without ever thinking about the complicated technology behind it. It will all be very accessible and very user-friendly. And easy mode is basically waiting until that happens. Hard mode is saying, you know what? Yes, I'll do the complicated command line prompt stuff. And this is basically, if you're not a tech native, if technology makes you even a little bit uncomfortable, I think hard mode is not for you. I still recommend that you watch this part to get a sense of why I'm saying that. So my recommendations for hard mode is, first of all, carve out a few hours a week to do your research and learning, right? You won't be able to learn enough in just a single session of a few hours here. Make sure that you can invest, over the next months or so, you can invest a few hundred hours into learning about this stuff. And you want to understand the basics of blockchain and of self-sovereignty and of key pairs and things like that. You really want to understand, what is this thing that I'm interacting with? Not that you have to learn how to code or anything like that, but just understand what's going on. And understand the difference between cryptocurrencies and various non-currency projects and coins. Learn definitely about Bitcoin, learn about Ethereum, learn about decentralized finance, and learn about layer 1s and layer 2s and how that's relevant to all this. Again, you don't have to understand this to the level where you can like develop your own software or anything like that. But just if someone's having a conversation about DeFi and layer 2s, you want to be at a place where you can understand what the hell they're talking about. So that's the research and learning component. The next really important thing for hard mode is to get your personal security, like your operational security and data privacy practices, reasonably airtight. I say reasonably because I'm not talking about the kind of thing where you retreat into an underground bunker and only interact with an air-gapped computer or anything like that. But you basically want to be at a place where you never reuse passwords. You use password managers and you have really tight control over passwords you use and the separation of passwords on different various websites and so on. And where you have no unencrypted sensitive data or traffic, so you don't have an Excel spreadsheet with all your passwords in it. You always make sure that you're on a secured connection before you log in somewhere and so on, right? You have to have this kind of security that makes it very hard for someone to break into any one of your accounts anywhere. This is really important. If that's not an ingrained habit, then you're really inviting trouble if you start interacting with crypto in any kind of real way. Also, obviously, you want to have two-factor authentication on everything, and you want to use a tool like Authy or Google Authenticator and not a phone number, because a phone number-based 2FA is not very secure. And it would also be good maybe if you get to the point where you understand why that is. And you want to have software minimalism. You don't want to be downloading all kinds of shit all the time. You don't want to be clicking on weird banners and things on the internet, right? You know the kinds of things that get people in trouble with various scams and phishing attacks and so on. And that's also a bit of like just basic self-defense there to understand what do scams look like, what do the most common attacks, both digital and social engineering attacks, what do these look like so that you don't easily become a victim of them. This is required because of the whole self-sovereignty aspect. Like if you're going to be a self-sovereign owner of your money, you are going to be your own bank and you are responsible for the security of that bank. And that is no small task. And of course, there's much, much more that goes into this, but basically get your personal security locked down before you start, moving big amounts of money here in cryptocurrency. Then, once you've done that, it would be time to sign up to exchanges. And in this case, I would recommend signing up to multiple exchanges because you want to establish multiple fiat on and off ramps. You want to have multiple options for getting fiat money into and out of crypto, and you don't want to be limited to just one place. And you want to decide on an allocation. And even in hard mode, I would recommend that you allocate between Bitcoin, Ethereum, DeFi, and maybe some meme coins, although the meme coins is really, it's up to you to decide, right? I'm not big on meme coins. But Bitcoin, Ethereum, and DeFi would be the big three. And you can look at DeFi projects, or you can buy something like DeFi Perp, or something like the DPI, the DeFi price index, which is like a basket or a bundle. It's like an index fund of decentralized finance projects. These, I think, are the things that make the most sense to create an allocation for how you want to use them or how you want to invest, how much you want to invest into them. And then you want to self-custody a portion of your crypto. So I don't self-custody all of it, but for me, it's essentially a way of risk management. There's going to be a portion that I have on something like an exchange. There's going to be a portion that I fully self-custody. And especially if we're talking about larger amounts, you don't want to have to trust a single source with larger amounts of your wealth. And of course, the fun part here is that if you go through all this trouble, you can actually interact with decentralized finance. You can start doing some banking without banks. And that can be really fun, but also try not to lose all of your money. Because again, we are in the early stages where everything is uncertain. You can make lots of money, you can lose all your money very easily, and it's all going to be your fault. You can't complain to customer support when you screw up and lose all your money. So that's how I would approach kind of hard mode crypto. Now, let's briefly talk about wallets, and this is relevant for easy mode as well as hard mode. You have a wallet, a digital wallet, that you use to interact with the blockchain and where you store your wealth and where you send and receive and so on. And the most important thing there to understand is basically custodial versus non-custodial. If you have a Coinbase account, you can also get a Coinbase wallet of some kind. And you essentially can use that like a wallet, so you can send and receive crypto from there. But that's a custodial wallet, which means someone else has custody of your coins. And non-custodial means that you yourself have custody of your coins. A couple of categories of wallets to know about are hardware wallets and mobile wallets. Among hardware wallets, the most popular are the Ledger and the Trezor wallets. And hardware wallets are often touted to be the most secure wallets, although I think they're very useful, but I think they're maybe slightly overrated because your basic OPSEC, your basic personal security practices are still the weak link. Once you understand about seed phrases and wallet recovery, you will realize that it really comes down to your seed phrase, which is essentially like one very, very long password. If anyone has that, then it doesn't matter whether you have a hardware wallet or not to secure your coins. And so you have to be able to safely custody your seed phrase in order to have true security. But having said that, I think hardware wallets are useful and they're good to know about. It's one of the things you basically need to learn about if you get into this. Then there's mobile wallets like the Garda wallet, Zengo, Argent. Here, the user interface is getting better and better. So with Zengo and Argent, in both cases, you have a wallet that basically makes the security a little easier for the user. You don't have to store and self-secure this seed phrase that I mentioned before. Zengo uses facial recognition as a recovery mechanism. Okay, so if you lose your password or you can't access your account, with your face, with a facial recognition program, you should be able, and this is obviously also meant to be secured, but you should be able to recover access to your funds. And that is more user-friendly than true private key self-custody. Argent uses a social recovery mechanism where you can dedicate other people to say, these people, if 4 out of these 7 people confirm that I am the real owner of this wallet, I can recover it even if I lose access to my phone or something like that. So this is something to look into. And there you also the key question is basically, how is this secured and how does wallet recovery work? That is the 2 things I'd want to understand about a mobile wallet when choosing which one to use. And then there's also the browser wallets and interactive wallets, primarily MetaMask and Wallet Connect. This is what you can use to interact with most decentralized finance apps. And here, I think these are very useful. This is where I think a hardware wallet is really good, because I like to use a hardware wallet together with MetaMask to interact with decentralized finance stuff. I wouldn't store a significant portion of my wealth just in the MetaMask browser extension for probably obvious reasons. I'm breezing through this stuff. At this point, you can probably see what I mean when I say that this stuff is pretty opaque, right? And it's pretty complicated. And there's just no way around doing your research, learning enough up to the point where everything I just said actually makes sense to you. There's no way around that. So that is kind of my crash course into what you need to know to get started investing in cryptocurrency. Personally, I am very optimistic about the future of blockchain technology. I believe and I hope that this will take over the world in the way that the internet took over the world. I think that would be better for all of us. So I'm very optimistic about this. But in terms of investing allocation, if I'm wrong about this and it all goes to zero, I won't be financially ruined. And that's also an important point. I hope this gives you a good place to start from. Like I say, it's very hard to even make a reasonably short video about this without overcomplicating everything. I think it makes sense, like I said, easy mode. I think easy mode makes sense for most people. And within a few hours of research, you should be at a point where you can decide, do I want to DCA into Bitcoin and Ethereum, and how much do I want to allocate? If that's all you do and you just stick with that, that is a great place to start. A quick reminder here, there's the DCA-CC website where you can do the calculations on this. We've looked at this before, right? So we can even look at something like Ethereum, right? If we invest $100 a week in Ethereum, we get started in 2018 or something like that, and then we can calculate what that looks like. Here we get these numbers. And as you can see, if you do this, like I suggest, if you do this with BTC and DCA, historically, if you backtest this, that works out extremely well. So if you can find a number where you say, I wouldn't mind if I lost all of this money, it just all goes to zero. But if this kind of trend continues, that would be really, really good for my financial future. If you can find a number that makes sense for you, then I think that is a good place to start. Now that we've looked at these different investment vehicles and you can start making decisions about how to invest and how much to invest, let's talk about updating your net worth tracking sheet. Like I said in the original video, the idea is to start with something simple and get used to it, build the habit of updating it. And then over time, you can add more things that you track. So let me show you a suggestion of what I would track and how I would update the net worth tracking sheet. So here's a look at the advanced net worth tracking sheet. And again, this is just a template. I will also make this available. You can make your own copy of this and work with this, or you can just expand the one you're already working with a few new items. So what I have here, the main difference, I still have incomes and expenses at the top here. And then I have assets and I have multiple subcategories within assets. And so the first is accounts and cash, where this would be my bank accounts, my PayPal account, my cash, and so on. And another item here that I've added is a separate account where you save for taxes. So this is another good reason to have a separate account, to open a savings account or something like that, where if you can calculate or estimate, at least, you can estimate how much you will owe in tax when tax season comes around, and you can start allocating a portion of your savings and put that in a separate account month by month. And that way, whenever you have to pay taxes, it won't be this big surprise where you maybe have to dip into your savings in order to pay it. You will already have saved up for that event. So that is another thing where you might want to add an account to specifically save up for your taxes. And then we have the personal runway account we've talked about and so on. Then we have the total that simply summarizes these. So that's our account, basically our cash total. Then I have a category called portfolio, and this is for stocks and such things. So here you can have your brokerage accounts. Maybe you have one, maybe you have several. Maybe you have your Robo advisor account and you add in the totals and we sum those up here. And then I have a third category for crypto investments. And here, I'll show this in a moment, you can basically use something like CoinTracker to bring together all of your, if you have multiple exchanges, multiple wallets, you can use this to summarize all of your crypto holdings. And of course, if you're doing easy mode and you just have like a Coinbase account or a Gemini account and you have some crypto there, then that's what you would put here. I have a second one here for DeFi where you could, if you're participating in DeFi, you can sum that up as well. And then we have a sum of these two. And here we have total assets. So this basically totals up our totals. So this is all of our cash assets plus all of our investments all summarized. And then like before, we have debts and everything else is the same. This is how I approach this. I don't put real estate stuff in here for the reasons I talked about in that video. I would, if anything, have a separate business that manages the real estate stuff, and I would pay myself a dividend from that business. That would be salary or income or something like that, right? That's why I don't have real estate here. But of course, all I'm showing you here is a way in which to do a simple tracking of your investments, and you can build this out for your own purposes in a way that makes sense to you. Then one more detail, I also like to have a separate tab here where I just sum up all my subscriptions. This is just all my personal subscriptions, because subscriptions can easily kind of run out of control and you don't realize how much you're spending. And here's how I do this. I have a title for every, this would be your Netflix, your Amazon Prime, your whatever. So every time I sign up for something, I add it here. Then I add the cost here, and I simply add month or year, depending on whether it's a monthly payment or an annual payment. And then here I tally up the annual cost. So everything that has a month here, and I just do this manually. I don't know if there's a way to automate this, but for every subscription I have that's paid on a monthly basis, I just take this amount here times 12 to get an annual number. And then down here, I have the annual total. So this is basically one place where I can see what I'm subscribed to and where I can see how much it's costing me in total per year. And that's just another neat thing to help me gain better control of my finances. So that is what my more advanced net worth tracking sheet looks like. Now, I mentioned Coin Tracker. This is a pretty useful app. With a free account, you can connect it to your various exchanges if you use more than one exchange for crypto. And you can also add your wallet addresses if you have multiple wallets. And it will show you an overview of all your crypto holdings as well as the price changes over time. And for a relatively low fee, you can also make it easier on your whole tax situation. So I think for most countries they have this. They can basically create a report that you can hand to your accountant or that will make the tax handling on your crypto investments easier to do. So that's Coin Tracker. I recommend that you check that out. And if you're interacting with decentralized finance, a great tool to use is Zapper. With Zapper, you can also just add multiple wallet addresses and it will give you an overview of all the different DeFi apps that you're involved in and where your money is and how much you're earning and so on. And a very similar tool to that is also DBank. So that's another useful tool to use. These things are useful in general, but they're especially useful for the net worth tracking because instead of having to collect data from all kinds of different places to figure out what your net worth is at that point in time, you simply have one app that you check. It shows you, look, here's the total sum. Here's the total value of all your DeFi stuff. And Coin Tracker will tell you, here's the total value of all your crypto stuff. So that's pretty useful and makes that step a little easier. Now, a few notes about the net worth tracking. First of all, an investment is not an expense. Just to be clear about that, right? That now we have our income, expense, and assets with investment assets. When you spend money to, you buy $100 worth of a stock or $100 worth of Bitcoin or something like that, that is not like buying a product for $100. So if I go do a grocery haul and I spend $100 on that, that is $100 that's gone. Right? It's now, I've converted it into food and stuff and I'm going to eat that food and that's it, right? But if I spend $100 on Bitcoin, I still have $100. Like in that moment that I make the transfer, I have $100. It's just that the denomination has changed. Before, I had this amount of value in US dollars. Now I have this amount of value in Bitcoin. So that is not something to log in your manual expense tracking. It is not an expense. It's more like, in fact, moving money from one account to another account. The expense associated with it, if anything, is the fee that you pay. So it'll probably cost a fee of some kind to make that Bitcoin purchase. So you buy $100 worth of Bitcoin, maybe it costs you $2 or something like that. The expense is $2. And on that note, unrealized gains and losses are neither income nor expense. So if I've bought $100 worth of Bitcoin and the next month it's worth $200, that's not income. And then the month after it's worth $50, that's not an expense, right? That is simply the value of this thing that I'm holding fluctuating. But until I actually turn it back into dollars, I have made neither a loss nor a profit. And also just to clarify, the way to use the net worth tracking sheet is that on the same day of every month, I do it on the first of every month. You simply enter the current value in all fields. So I check my bank account and I look at how much money is in here right now. And that's what I enter in the row for that bank account. And then I look at my crypto portfolio and I go, okay, what's the value of this right now? That's what I enter. And I look at my stock portfolio and I go, what's the value of this? Essentially, what's the value if I sold it all right now? How much would I get? And this is often called the total liquidation value. Right, so if you liquidated your entire portfolio, how much money would you get? And that's the number I enter. Like I said, I do this once a month on the same day, and I enter the current value, and you don't worry about movements that happen in between. So today I'm entering the account value of my stock portfolio, and then a few days later the value is up, a few days later the value is down, and so on. It doesn't matter, right? I just enter it again on the 1st of the next month. Remember that the purpose of the net worth tracking sheet is not to have a complete picture of all the movements, all the fluctuations, every single thing that's going on in our financial life. We want to capture snapshots once a month, and the value is that we are measuring something that matters, right? And we have a clearer picture of what's going on in our financial life, and we're measuring something that, well, it's following the what gets measured gets managed principle. Even just measuring your net worth puts you on the path to increasing your net worth, while as not doing it and being blind about this is a great way to basically not build your net worth over time. Just to be clear, right, this is not an accounting of every single thing that happens. It is these snapshots that put us on the right track to building wealth. And then, like I've mentioned before, these are just suggestions. Feel free to customize this to your own needs. And the only thing I would say is don't overcomplicate this. Don't build a system that you end up not wanting to use because there's too many steps involved or it's too complicated. But of course, if you have your own solutions and your own ideas to share, I'd always love to hear about them. So let's talk about that in the community. Let's talk about banks, savings, and safe returns. So it used to be that you could get a savings account and that would be kind of a safe way to get returns on your money. And that has gone away. But I think there are new opportunities arising that it's really valuable to know about. Now, to understand this, let's do a bit of a history lesson. As always, knowledge is power. So let's arm ourselves with more knowledge and more insight than most people ever have about this kind of thing. Let's start with the following idea. Let's say that what I want is a shoe. I need a pair of new boots, and you make boots. So that's great. The problem is, all I have is cows. So we live in a pre-money society. I have cows, I need boots, you have boots, but you don't need cows right now. And also, a pair of boots is worth less than an entire cow. So we've got a problem right there. So if we're just bartering, how do we solve this? Well, we need to introduce at least one more party. Or maybe what you want, you don't want cows, but you want eggs. And someone else has eggs and they want cows. And so I can exchange a cow for lots of eggs. Again, not sure how that would work out. But let's say I exchange a cow for lots of eggs and I exchange some of those eggs with you for the boots that I want. This is a possible solution to this. But as you can tell, this is not an ideal solution. And this is where money comes in. If we have something like, let's say, gold coins, and we all agree that we use these gold coins as a way to exchange value with each other, this can now work because I can sell my cow for gold coins, or one of my cows. Now I have these gold coins. I can take a portion of those gold coins, give them to you to get the boots I want, and then you can take a portion of those gold coins, give them to the person who has the eggs to get the eggs that you want. So this is essentially why money arose. It is a medium of exchange that takes a lot of friction and a lot of problems out of bartering. So that's why we have money in the first place. But now we have a new problem. We're carrying around all this gold. And especially for larger transactions and longer distance transactions, this is really not great. Because now what I'm like dragging a cart full of gold across the countryside, making myself very vulnerable. And it's just not great. So that's the new problem. And how do we solve that problem? This is where banks come in. And this is why we're talking about this in the first place, because I think it's valuable to understand what got us here. Here's how it works. I have a bunch of gold and I put it in a bank. The bank puts the gold in the vault and gives me a bank note. And the bank note basically says, Shane has this amount of gold in the vault. And now, instead of dragging around a bunch of gold, I simply have a banknote. And this makes it much easier to do large transactions and smaller transactions and longer distance transactions and so on. So that was the original purpose of the bank, to basically enable this exchange of value and remove some of the friction out of this. And here's an important insight. We don't need banks for this anymore. This is something we already looked at in the cryptocurrency video. And basically in the digital age that we live in, the service of enabling these transactions between people, the medium of exchange, This is something that can be done at a completely marginal cost, and it can be done by code instead of humans. So the idea that what the bank does is provide this service of, oh, you can store your money with us and we allow you to pay and receive and so on. We don't need banks for that. And I mention this because if a bank tells you this is the service we're charging you for, this is why you have to use us, and this is why it costs money to use the bank, that is a very old-fashioned idea. And of course, banks have put us in a position where they basically say, listen, we're not giving you interest anymore, but the benefit we're giving you is, oh, you get a neat app and you can send and receive money. And we're going to charge you, conversion fees and this fees and that fees all over the place, right? But that's the service we're providing. You can send and receive money. It's like, no. We don't need banks for that, and it doesn't need to be that expensive. And of course, in response to this, because the banks are trying to play this game, this creates an opportunity, and this opportunity is already being filled. We have these neobanks that have come up. So that's banks like Wise, formerly TransferWise, Revolut, Venmo, N26. These are basically banks or bank-like companies and applications that provide this kind of service, but provide it in a much more user-friendly and much cheaper way. This is not an endorsement of any of these specifically. I have only used Wise and Revolut among those two, and I like Wise a lot. I don't like Revolut as much, at least their business account. Wise is genius. It's really, really good for international transfers. And I think they're pretty much solely responsible for making many of these other neobanks lower their fees for currency conversions and international transactions by a lot. And that's just an example of where the banks, with their greed, basically created an opportunity for new competitors to arise. In my opinion, it makes a lot of sense to use something like Wise instead of using a traditional bank for both like storing some of your assets, like storing some of your savings, and for lots and lots of your payment sending and receiving and so on. Now, Wise makes no secret about the fact that they're not giving you a savings account. You can have multiple accounts, so you can create, they call them jars. You can create an account for example, saving up for your personal runway, but they don't call it a savings account and then give you 0.01% interest, right? I mean, that's just ridiculous. They just give you no interest and say, hey, here's just a convenient way to make multiple accounts to keep track of different things or save up for different things. So they're, in that sense, much, much more honest than traditional banks. But there is more to this story, because another function that a bank has is that the bank doesn't just keep your money. They use your money. They're basically using your money, and originally the first thing they did is they would lend out money. People bring them their money, and the bank lends out that money to people who need to borrow it, and the borrowers pay interest. And the lenders, so the people whose money the bank is lending out, they receive interest too. And that's basically where originally the interest account came from. The bank is basically saying, I'm going to use your money to lend out, and I'm going to earn interest on that. And later on, also, investment banks, basically, I'm going to speculate with your money, I'm going to invest your money, and it's going to generate returns, and you are going to get a slice of that pie. You're going to get a portion of the returns that the bank is generating with your money, which is only fair, isn't it? I mean, that makes sense. But that has changed, because now banks are still doing this, right? Banks are still in the business of lending out your money, investing your money, speculating with your money, every once in a while tanking the entire world economy, with your money. But they've cut you out of the deal. They keep all the profits for themselves. And this is why, again, it's just so dishonest that they're trying to tell you, oh, no, you get a nice app and you can send and receive payments. It's like, come on. That is not what the original deal was. But the cool thing is, in the cryptocurrency space, this deal, this borrowing and lending and so on, is re-emerging with the middleman, with the bank cut out. And that's pretty exciting. So let's look at two types of solutions here. First of all, we have custodial solutions. So these are centralized solutions. You basically, you have to trust these institutions. They're offering you something. It's like, is this going to work? Are they going to go bust? I don't know, right? But you're trusting them, and usually it's easier. It's more approachable. The biggest player here that has recently emerged, or they've come out with a new offer, is Coinbase. Okay, Coinbase have come out with this offer where on USDC, which is a US dollar stable coin, so it's a US dollar equivalent, you can earn 4% per year. So that is like an old school savings account. 4% isn't groundbreaking, but like we've seen, compound interest is really powerful. If you put your money in here instead of into a savings account where you get nothing, over a long enough time, that can make a big difference. And Coinbase I think they can be trusted with this. We'll have to see. This is a very new thing, right? We'll have to see if they lower this rate over time. We'll have to see what happens. But it's very interesting that this is coming up. Just like the neobanks arose when the shenanigans and greed of the banks created an opportunity, this is happening here again. And there's like this re-emergence of something like a savings account. There are also some other solutions. For example, Nexo is one where you can earn on euros and British pounds and USD, and you can earn interest on that, and you can also earn interest on crypto assets. And another one of those is Celsius Network. Same deal, you can earn on stablecoins as well as on crypto. And both of these, basically the way they work is exactly like the old school banking system, where they will take your assets and they will lend those out, and they will possibly also invest those. You have to look into the details of what exactly they do with your money. But they are essentially using the money that their depositors provide to earn, and they pay out some of those earnings to their depositors. That's the basic idea. However, I have to say one thing, right? You're seeing here 17% and Nexo claims something like 12%. These APY numbers, so that's the yearly returns, these are generally misleading. If we take a look at Nexo, for example, if we go to earn, and let's say we want to earn on stable coins, here you can see that you can earn in kind. So you deposit euros and you earn euros, that lowers your APY. And if you earn in Nexo, which is their own token, their own cryptocurrency, they give you more. But of course, that's not the same, right? It's like if you're earning, you deposit euros or Bitcoin or something, and then you earn Nexo, well, the value of Nexo might just tank. It's not the same. So you have to take that with a grain of salt. And even so, even here, you only get your 10% if you lock your euros up for like 3 months or 6 months or something like that. So the actual interest starts at something like 4%. And then, if you own Nexo token, you get a bit more. And if you earn in Nexo, you get more. And if you lock it up for longer, you get more, and so on. And here with Celsius, we have a similar deal, right? If we go to earn, let's see. So at the top here, it says earn up to 17%, right? And there's some more information here. At the bottom, there's a calculator where we can see. So you can get some more information about what's going on, right? So you have United States and international rates that are different. And you can earn in Cell, that's their own token, which I don't recommend, or earn, if you deposit Bitcoin, you earn Bitcoin. But here you can see like it's 6% on your first BTC and 3.5% after. And these rates can also change over time. And we can also look at stablecoin rates here. I don't know if they have any other deals. So I haven't used Celsius myself. They might also have some further requirements for you to actually get your 8.8%. That's just something to be aware of, that generally, there's probably like one specific scenario under which you can earn 17%, but it's pretty misleading what they're showing here in the big headline. But even so, I think it's important to know, right? Don't be misled by these numbers. It's important to know that, the 4% that Coinbase is offering is not that much lower, or maybe not lower at all, than what others are offering. They're just advertising it in different ways. But still, right, like I said, even 4% is way, way, way more than you get with any traditional bank. And we'll have to see what happens next, right? Maybe banks will bring back interest accounts. Maybe they'll just die out. I don't know. We'll see. There's also decentralized solutions. And this is where it gets really interesting, but this is hard mode stuff, right? This also gets pretty complicated. But it's good to know about. Most people don't know about this yet. So we have lending and borrowing solutions. The primary ones currently are Aave, Compound, and Cream Finance. And here you have exactly this deal where you can deposit your assets, crypto assets, stablecoin assets, and other people can borrow them, and you simply earn part of that income that's generated from the borrowing fees. If you take a look at Aave here, we can see what their rates are currently. And you can see that currently these are pretty low. So you can borrow dollar equivalents for under 4%, and you earn under 3% for them. And on other assets, it's even lower. So you can see that on Ethereum, you're earning basically nothing. On Bitcoin, you're earning basically nothing, right? But here's the thing with these rates fluctuate over time because it depends on demand. So the higher the demand is and the less supply there is, the higher these earnings can go. I have seen the stablecoin rates on Aave be as high as 12%. And I've seen them, this is about the lowest I've seen them so far. But this is because it's decentralized, because it's code-based. It's not a central authority that decides here's how much you're going to have to pay or here's how much you're going to earn. This is all based on code that tries to keep a balance and tries to keep people from getting liquidated. And so it basically is supply and demand dependent. That makes it a bit less predictable, but it also makes it less trusted, right? You don't have to trust this central institution to take care of your money or make good decisions. It is all based on code. And that is just one of the most popular solutions for like this borrowing and lending, essentially banking without a bank. In addition to that, there are also opportunities in the crypto space to earn money as a liquidity provider for decentralized exchanges. And as you can probably tell from that sentence, it gets pretty damn complicated. This is definitely not an easy solution. But it's important, or it's worthwhile to know about this. Some of the leading players in this space are Curve Finance, Uniswap, Balancer, and there are many others. And this is another opportunity where you can basically make assets available and you can earn in exchange fees. Basically, users of these platforms are making trades or swapping between different coins, and you're providing the liquidity for that to happen, and you're earning a portion of the fees. This can also be, this is a whole like financial system without central authorities, without banks. I'm very excited about this, but I also want to say like this is an earning opportunity. It's good to look into this, but this is highly complicated. This is highly, highly complicated. And you have to be aware of what you're doing. You have to know about impermanent loss and so on before you decide to put your money into one of these vehicles. But the point is, there is a future of what used to be a savings account, right? There used to be a savings account where you have a way to benefit from the financial activity that is happening, that the bank is doing, and you could get a pretty safe, pretty stable return in exchange. Right now, there's these new solutions emerging, some of them decentralized, some of them trusted or custodial. And right now there's early adopter risk to all of these. I don't think that if you put your money into something like the Coinbase Earn program, I don't think that you'll just lose all your money, right? But it's possible that they go, oh, we have to lower the rate to 2% or something like that. We just don't know what's going to happen. So I think there's not a huge risk. If you put your money into something like Aave or you do liquidity providing, there's greater risk and also greater returns. That's how it usually goes, right? And it's very, very early for all of these. So in general, I recommend that if you want to participate here, I recommend a low allocation, right? Put like maybe 10% of your net worth into something like this and start earning this interest. This may already be a better alternative than a savings account, because many savings accounts basically only cost you money. They'll charge you a bunch of fees. They'll give you basically no interest. And so this is already a better alternative. And it's really, again, just about risk management, really. And most of all, it's good to keep an eye out on this, because the longer this keeps going, the more this matures and the longer this survives, the more this could become the new norm. And you could be in a position to be one of the early people who benefit from this before it just becomes the normal thing that everyone does. Now, even in easy mode, right, even if you don't want to get into the deep end of crypto, I think it's worth maybe just chucking a bit of money into something like the Coinbase Earn thing or something like Nexo or something like that. Again, an amount of money where even if you lost it, it wouldn't hurt too much. Chuck it in there, start earning interest, kind of forget about it for a few years and see what happens. We've been talking about how investing can make your money grow, and that of course is fantastic. But we also have to talk about the other side of this. Just like you can make gains investing, you can lose money investing. And that's simply the flip side. You can invest in something that goes up in value and then you're very happy about it, but you can also invest in something that goes down in value, and that is a bad time. And what's important to understand here is that the next crash is coming. the next downturn, the next recession, the next crash, whatever you want to call it, it is coming. It's a certainty. We know it's coming. And in fact, if you look at the economy, like by all rights, it should already be happening. You can see all these different signs. You can see prices going unsustainably high. You can see crazy amounts of money printing. You can see crazy amounts of debt and so on and so forth. There's always these signs where the more you look at it, the more you go, oh my God, we're teetering on the edge. But that is basically always the case. That is always true. No matter when you're watching this and no matter when you look historically, there's always some doom and gloom scenario. And in fact, even in the middle of a crash, even when prices are super low and everything's already collapsing, there will still be lots of people saying, no, it's going to get worse. The prices are going to go even lower. And there's the same thing, right? Literally, no matter where you are in the cycle, no matter when you are on the timeline, there's always the doom and gloom predictions, just like there's always people saying that there's lots of growth still to be had. And okay, maybe you're thinking, okay, I know what you're saying, but some financial guru says that the meltdown is imminent and Michael Burry is short, and that doesn't refer to his height. I'm not going to explain that joke. It's just like either you get it or you don't. But this kind of thing is always happening, right? And maybe you're thinking, no, but this time, I heard some guy talk and he made a very convincing point about why everything is about to collapse, And it's important to remember that a general rule is that for every economist, there is an equal and opposite economist, right? For every well-informed economist who's studied the markets for decades and who can make a really good case about why everything's about to blow up, there's going to be at least one equal and opposite economist who's also very well informed, has also spent decades studying the market, and is basically saying the exact opposite. A really good take on this, or like how do we deal with this, right? A really good take on this, I think, comes from Peter Lynch. Peter Lynch is also one of the investing legends. And he basically said this: more money is lost trying to time a downturn than in the downturn itself. He is also someone who has said that the next crash is always looming. There's always people telling you that everything is about to collapse, right? And trying to time this, like trying to catch the next crash or trying to protect against the next crash, actually, that's how more money is lost in the end. Now, let's try to understand this a bit better and look at how specifically the money is lost. So if you're trying to time the next downturn, how exactly are you losing money? So there's basically two main categories or three ways in which money is mainly lost trying to time a downturn. One is opportunity cost. So if you're just sitting on the sidelines thinking that what I'll do is I'll wait for the next crash and then buy at the bottom, how will you know when the bottom is? But never mind, you'll buy at the bottom and that will be like the investing opportunity of a lifetime. So you're just sitting on cash waiting for that to happen. But who knows, maybe the next crash comes 3 years from now, 5 years from now, 10 years from now, and you're just sitting on the sidelines while prices are going up and you're not getting any of those gains because you're still waiting for that dip. Another one is also, or like the more extreme version is you can actually bet against the market. So that's what going short is about, right? Normally you buy an asset and when the price of that asset goes up, you make money. But you can also do the opposite. You can essentially bet against an asset, which means that you'll make money when the price goes down. So if you're convinced that the next crash is about to happen, then you can lose a lot of money shorting the market. And it could also just lead to bad investment choices because you're fearful, because you're convinced that there's a crash coming. So, maybe someone is telling you that next time the market crashes, when there's a crisis again, then gold prices will go up. So you buy a bunch of gold and then, gold goes sideways for 10 years while other assets go up in value, which is another form of opportunity cost. So that's really what Peter Lynch means with more money is lost waiting for a downturn or trying to time a downturn than in the downturn itself. Because you can miss out on so much growth or even lose money on shorts to such a degree that if you would just buy and hold and, then the prices go down, then they come back up again, you end up actually making more money. But with all that said, I am not suggesting that the next crash is not coming. It is absolutely coming. And once again, we can take a look at Tradingview to actually get a historical view of this. So let's look at the Dow Jones Industrial Average, which is a market index. And we can look at this on a long time frame. This is a weekly chart. So every one of these candles here represents 1 week of trading. And as you can see, we can go far back here. And one of the things you'll notice is that these downturns happen often. So the last time we had this was not that long ago, 2020, March 2020. Asset prices, or the Dow Jones, went down by almost 40%. Although in this case, there's debates about whether this wasn't really a market correction, or maybe it was, maybe it wasn't, because it took less than a year for prices to make new all-time highs, right? So in less than a year, in just a few months really, this crash, the market completely recovered, and that has a lot to do with all the money printing that happened. Here, of course, this one was like a real recession, a real crash. This is 2008. Here, the prices went down, so the Dow Jones went down by over 50%. And as you can see, it took more than a year. It took 500 days from the previous peak all the way to the bottom. And it took, 2,000 days to reach new all-time highs. And at the bottom here, you can see that's October 07 to February 2013. That's how long it took for prices to fully recover. This is what like a real market correction looks like. And this kind of thing happens like every 10 to 15 years. So if you scroll through a chart like this, you can see this kind of thing happening again and again. This here, there's a correction here. I don't know where you would measure this, but this is also a pretty sizable downturn. So here we go down 36-ish%, and it takes quite a while for it to come back. So that's from 01 to 06. This would be a correction. Then if we go back, here's a pretty clear one, right? This is in 87. Here we have minus 40%, so that's pretty severe as well. And it took, for proper recovery here, it went sideways a little bit. So we have like 3-ish years, about 3 years. And this kind of thing, again, if you just scroll through this chart, you can see how this basically just happens all the time, right? So here's the next one, here's the next one. Especially on a view like this where we're looking at multiple years on a single screen, you can basically see these corrections happening all the time. And there's no reason to believe that it won't continue happening. It's basically just a normal part of how markets operate, is that you'll have these upwards trends, corrections, upwards trends, corrections, and so on. So the question here really becomes about, since we know that these corrections happen periodically, but we don't know when, we can't time them properly, or we can't time them with precision, how do we play this smart? How do we be smart about this and incorporate this uncertainty in our investing? This brings us back to one of my favorite questions. You're familiar with this now. When I look at something like this, what I always want to know is like, how do people fail, right? How am I likely? What are my weaknesses? What are my biases that would make me likely to lose money here? And how do most people fail here? And here's what I've taken away from examining this question. So I think the worst thing you can be is a fearful investor. If you, as we've talked about before, if you have a dollar cost averaging strategy and a buy and hold strategy, and you just stick to that, that is actually exactly a strategy to counteract all of the problems that a fearful investor will have when price moves. And this is where a fearful investor will not stick to the strategy, right? A fearful investor will be investing and doing the DCA while the price goes up. But then when the price goes down, you start to panic and you go, oh my God, I should sell, or I don't know if I should keep DCAing. I mean, the price is lower and so on. And then you break the strategy and you lose out on some of the best gains you can get in the long term. One thing to ask is, have the fundamentals changed? And if no, don't sell. So let's say I bought some Apple stock because, as we've talked about before, Apple is a great company, as defined like the Warren Buffett definition of a great company. So we bought some Apple stock, and now there's a recession, right? There's a market crash. Prices of everything are going down, including prices of Apple stock. So I'm losing money on Apple stock. Now the question is, has anything fundamentally changed? Does Apple not make iPhones anymore? Have they lost all of their customers? Are they not selling lots and lots of hardware products and subscription services and so on and so forth? Have the fundamentals changed? Because originally I bought this thing because it's a strong company with strong products and lots of loyal fans and so on. Have these things changed? No? Well, then the price going down shouldn't matter. That's not a reason to sell. So if you can remain calm and stick to your strategy, that protects. Whereas if you are fearful, that is how you get wrecked, because that's going to lead you to sell when you see the numbers go down, panic selling. And it's also going to lead you to hesitate in getting back in. Remember this graph here that we walked through? This is exactly what happens, right? You panic when prices are low. You sell because prices are going down. And then as prices rise, you're in disbelief, you're hesitant, and you don't get back in. And then you get back in too high, and so on and so forth, right? This exact thing is going to play out in the next market correction, in the next crash, if you don't stick to your strategy and if you let fear dictate your actions. When you make investments, make sure you have strong reasons for those investments so you know what you're doing and you know why you're doing it. See, if nothing else, this is why it's so important that you don't just follow someone else's advice, right? If you just follow someone else's advice, that leads to very low conviction. So if it's just like your cousin Timmy told you, hey, you should buy Apple stock, and you buy Apple stock, the price goes up and you're like, oh, this is cool. And then the price goes down and you panic. It's like, well, why did you buy it? Well, your cousin told you to. That is such a weak reason. Like you never had a really good reason to buy this thing in the first place. You never actually thought about what you're doing. You were just hoping that, number would go up. And so as soon as you're starting to lose money, you're going to panic and fear is going to take over. And like I say, if nothing else, this is the reason why in this class I'm so insistent on talking about fundamentals and building up real knowledge and not telling you what to do, but giving you the tools to make your own strong conviction decisions yourself. Because only if you have a strategy where you have a strong conviction, where you know what's going on, you know what to expect, you know what you're doing, only then will you be able to stick with that strategy, even in the more difficult times. Now, another thing you can do to prepare for the next downturn is to invest in crypto. And you basically get numb to crashes. And I'm kind of half joking about this, but it's true, right? In crypto, you can essentially get in the repetitions of going through crashes and going through corrections. You can experience 30% plus drawdowns in crypto, multiple times a year, usually. And you can experience 80%, 90% crashes, depending on what you invest in, all the time. And it's pretty funny because in the equities market, if you have a 30% downturn, everybody panics. And you'll have, the worried Wall Street guy, looking at the charts going down as the image of on all the websites and all the articles and so on, right? 30% downturn is the end of the world. In crypto, it's like a Tuesday, right? That's just one of the things that happens all the time. And you do get numb to it. And I think it's one of the great opportunities that crypto offers is that you can go through these cycles at an accelerated pace. You can make your mistakes at a faster pace. And you really do get numb to the price movements by being exposed to crypto. So not that that's a reason to go all in on crypto, obviously, but that's one of the advantages where even if you don't have a strong conviction in this asset class, it's good to get, or it can be useful to get a little bit of exposure just to get the reps in on these crazy movements. And the high volatility and this aspect of it is one of the reasons why I'm generally enthusiastic about crypto. The mainstream approach with finance and investing and all this kind of stuff is always to take the edge off of everything. There's always all this talk about regulation and protection and insurance and so on, where essentially the government is always trying to helicopter parent everyone, right? Everything needs oversight, everything needs all this stuff. And I'm very skeptical of this because the talk is always about protecting the consumer, right? It's always like, oh, we're doing this for you. But then the reality is, when investment banks tank the entire economy with their pure greed and irresponsibility, who's on the chopping block? It's the consumer, it's the average Joe who pays the price for that, right? All the talk about protection doesn't actually protect the average consumer when it really matters. And if you look into what's happening in the financial markets, if you look into what happened in 2008, it is just hair-raising how disadvantaged the average person is and how much they're just being screwed over. And the same thing is happening again. The same thing has probably happened since the first days of Wall Street. So there's all this talk about protection. And this is why, we're shielding you from all this stuff. And this is why you have to jump through all these hoops and so on, right? Let's talk about this protection. But there's no real protection. There's no real protection against you making irresponsible decisions with your money. And there's no real protection against you getting exploited. And in general, I say screw that. Screw all of this. I don't need to be coddled. I don't need to be helicopter parented. Get your battle scars. I would rather do what I need to do to become highly capable, to actually understand what's going on, And I don't want to be coddled and protected, right? I want to be a participant. And this is where my views are libertarian, essentially. When it comes to this kind of stuff, just get out of my way. Like, let me lose my money if that's what I want to do, but at least I want to lose it on my own terms. I don't want to be screwed over in a super opaque system by people who already have more power and money than is good for them. All right, so that's enough of that little rant. Let's talk about another thing that always comes up when it comes to talk about risk and downturns and so on, which is diversification. This is a mainstream thing as well, where it's always like, have a diversified portfolio. Now, we've encountered this idea before, right? This is why investing in something like the S&P 500, which is equivalent to buying 500 stocks all at once, this is why that tends to work really well for passive investing. You don't have to pick individual companies that are going to do well. You just go, hey, out of all these 500 companies, overall, they're going to do pretty well. And that's great for a passive investing approach. And the idea is that diversification is a good thing. And the question is that what we should do? Does it protect against this kind of risk? So, of course, when you put all your eggs in one basket, there's more risk. If you put all your money into just one stock or all your money into just one crypto coin or something like that, there's lots of risk, because if that one thing fails, then you've lost all your money. That's so much is obvious. So if you buy 5 stocks instead of one, that does lower your risk, because if one of those companies fails, you haven't lost all your money all at once. And we can scale this further, right? If you buy thousands of stocks and bonds and real estate and so on, then it's extremely unlikely that you lose it all at once. And here it's important to distinguish between asset classes, because if you just buy many different stocks in many different companies, you're still invested in one asset class. And when there's an economic downturn, basically all stocks go down pretty much, right? So there, the diversification doesn't save you entirely, but it can still kind of dampen the blow. And further diversification is going into multiple asset classes. So we have stocks, bonds, cash, real estate, crypto, etc., etc. And like I said, that does soften the blow. And in fact, let's have a look at some examples. Let's have like a perfectly diversified portfolio, right? Let's say we have a total of $10,000 invested between equities, bonds, cash, commodities, real estate, crypto, precious metals, and maybe some art and some other, other things that hold value, okay? We have 8 different categories here, and we have $10,000 in. So let's look at what happens here in different scenarios. First, let's just assume kind of a normal growth period where equities go up by 20%, crypto goes up by 40%, real estate goes up by 10%, and everything else basically remains flat, right? Like your cash will lose value very, very slowly, bonds will gain value very, very slowly, and other stuff will basically remain flat. We'll just assume that, right? That would be like a normal growth period. So what does that look like? This is our starting point, right? $10,000 invested, and after this growth period, here's what it looks like. And as you can see, not much changes. And we have now a total value of $10,875, or 8.7% in growth. So the good thing here is we've gone through a growth period, and indeed our asset value has increased. But the bad thing is that even though one of the assets we hold, crypto, has gone up by 40%, overall we've only gained 8.75%. So that's the downside of diversification, right? It takes the edge off of the fastest growing assets we hold as well. So it takes away some of our upside, essentially. But then that shouldn't be the only scenario we look at. So let's also think about what would happen if a recession happens, if a crash happens. And let's assume the following numbers. Equities go down 30%, crypto goes down 70%, real estate goes down 20%. And then let's throw a bone to the gold bugs, right? People who hold precious metals as a hedge against downturns. Let's say gold goes up 30%, maybe commodities go up a little bit as well, and everything else stays more or less flat. What happens here? So here we have a serious downturn in many asset classes. And in our portfolio, so we start here with $10,000, and this is what happens in this crash. Basically, as you can see, this really softens the blow, because overall we only lose 10%. We still lose. We're not totally shielded against the downturn. Again, it just softens the blow, right? Where some people have lost 2/3 of their wealth, we've lost 10% of our wealth. And this is basically what wide diversification does. So diversification preserves value, but it does so at the expense of upside. And this is why I'm talking about this, because remember how we talked about increasing that gap. We want to increase our income and decrease our expenses. We want to widen that gap because within that gap, that is where our wealth grows, or our potential for wealth, right? Everything we can invest comes out of this gap. And with this in mind, for growing your wealth, for building wealth, being overly diversified is not very useful, because preserving value is not the same as building wealth. So I think being really widely diversified is more for like old rich people, essentially, right? It's like you already have a lot of wealth and you just want to hold on to it. Whereas if you're trying to build wealth, I think being too diversified is a mistake. Although, as always, I'm not telling you what to do with your money, just laying out some ideas to help you make better decisions. So let's think about the value of concentrated bets, because when it comes to growing wealth, having more highly concentrated bets is usually a good thing to do, as long as you have good reasoning. And that doesn't mean that you have to take on irresponsible risk. So for example, if we look at the past 2 decades, we've had immense growth in tech stocks. And really, you didn't have to be a far-sighted genius or a crazy risk taker to start making some concentrated bets on tech stocks at some point within the last 15 to 20 years, okay? So I've shown this example before. If you go back to 2012, 2015, something like that, you can look at the tech sector, you can look at a company like Apple, you can look at a company like Google and be like, look, I'm not taking a massive risk putting some money into this. Like, I can see that this is a growth market. I can see that there's a lot of room for this still to grow, right? Like, the tech revolution is still happening. It's like, why not get on board? Instead of being diversified across all kinds of stuff and having, bonds that yield you 2% a year or something like that. And I think these kinds of opportunities come along periodically, right? I think we probably can all get at least 1 or 2 of those in our lifetimes, where some new thing, some new wave starts cresting, and we don't have to be the very first. If you're the very first on a new wave, okay, you're going to be a billionaire, great stuff, but you don't have to be the first. Like, you can watch the wave cresting and simply don't hesitate for too long and then start making a bet when this thing is already rolling. I think that is a good approach. And for me personally, this is one of the reasons behind some of the ideas I've shared here. This is why, okay, cash. Do you want to have cash? Well, for me, cash isn't for diversification, right? Cash isn't for hedging against downturns or something like that. It's for your personal runway. You want to have cash that if you lose your income, you can keep going for a while. And that's it. Things like bonds, savings account with almost no earnings and all this kind of stuff. No, not interested. Same reason. I'm not trying to preserve value here. I'm trying to grow. And I have enough time as well, right? I can survive a downturn and wait for prices to recover. And this is also why I like, narrow to medium index funds. And by that, I mean, something like the S&P 500, that's 500 stocks. Yes. Something like the Russell 2000 stocks, I don't think that's necessary. That's a bit too much diversification for my taste. I'd rather go even narrower into tech stocks or into some of the other index funds or ETFs that I have presented here. And this is the reason why, right? I'm not trying to preserve value, I'm trying to grow value. And then with crypto, the same thing. I'd rather make a relatively concentrated bet here on few coins because I think that there's a good chance here that there's a lot of growth to be had. But of course, this is just my current setup, and I'm just trying to explain the thinking behind this. And I'm happy with the risk profile here. So, I'm not going to be blaming anyone else if I lose all my money following this strategy. So this is still not financial advice, and I'm still just some guy who doesn't have a clue. Keep that in mind. Now, on the topic of crypto, let me use this as a further example of this diversification problem, because you can also be overly diversified in something like crypto, where you have very high volatility and a lot of growth potential, as well as a lot of loss potential. So even there, you can be enthusiastic about crypto and say, yes, I want to invest in this space, but then you end up investing in too many projects and too many coins. So once again, we have here a perfectly split up pie between 8 different projects, one of them being Bitcoin, and all the others being, meme coins, doggy coins, whatever project coins. And we put $10,000 into that. Now, what's the scenario? Well, just crypto things, right? Just what's normal in crypto is like over some time period, Bitcoin goes up 40%. most coins go down like 95%, and then that one meme coin goes up like 1,000%, right? This is just normal in crypto. This is how it goes. So how does our portfolio react to this? This is what it looks like, right? And here you can see that this is actually pretty good. We made 46%, right? We went from 10,000 to 14,000 basically. And this is pretty good, except that's almost the same as just holding Bitcoin. And that is assuming that you manage to pick one of those coins that does extremely well, which is all but guaranteed. And it also assumes that you manage to sell that one coin that blows up at the right time, not too early, not too late. And when you take that into account, you soon realize that, being overly diversified doesn't help you, even if you manage to pick a winner. So even in the crypto space, I think it's much better to make some concentrated bets rather than to spread yourself thinly among dozens and dozens of coins. So all this is to say that yes, the next crash is coming and no one knows when, but you can and you should plan accordingly. Let's talk about some zero-brain strategies for wealth building. And I mean this in an entirely positive sense. So I'm not talking about if you do this, that indicates you have zero brains. I'm talking about this is the kind of thing that literally needs zero brain power to do, right? There's zero friction to do this. And you don't have to be timing the market. You don't have to be studying macroeconomics. You don't have to be a trader. You don't have to do any of this complicated stuff that, yes, you can do successfully, but it requires lots of brain power. It requires lots of time and dedication to do. And, depending on how deep you want to get into the world of managing your finances, actively investing and so on, maybe you want to dedicate this brain power and time. But it's important to know that there are also ways to put yourself on track of wealth building that really require just zero brain power. And that's what we're going to talk about. So you can also think of this as the forget about it and get rich approach. And this is something I became enthusiastic about when I realized something. Let me show you a graph here. This is my crypto assets. Okay, this is a graph of my crypto assets, the value, the US dollar value of my crypto assets over time. And as you can see, this started in 2017 and then went all the way through, as I'm recording this, it is mid to late 2021. Now, what you can't see on this graph, or what's not clear on this graph, is that in this period here, I was down on my portfolio something between 50 and 70%. I think at the lowest point, it was close to minus 70, maybe it was minus 65 or something like that. But we've looked at this before because this is not on a logarithmic scale, and because the spike in value later on is so high, it makes that entire period look like a flat line. But actually, that was a period of really brutal price swings, and there was a lot of drawdown in that period. For me, this taught me the value of basically forgetting about my investment, because I got into crypto in 2017. I got interested in it. I learned about it. I started allocating a bit of capital to it. And then a huge price collapse happened, which I wasn't surprised by. By the time this happened, I had already learned about previous cycles, and I was like, oh yeah, sure, the price just collapsed in half overnight. That's one of the things that happens. I was convinced in the long-term value of what I'd invested in, so at no point did I think, oh, I have to sell. What actually happened in this period is that I basically forgot about crypto. So I got busy doing other stuff. I got busy with my businesses. And initially, I was still following crypto news and following the price and so on. But for at least 2 of those years, even longer perhaps, I basically just forgot about it. I still knew that I have this portfolio somewhere. I still updated my net worth tracking sheet, but I was just entering the number. I didn't think about it, right? I didn't think, oh, how much am I down or whatever. I was just too busy with other stuff. And this was a good thing. At least so far, my thesis has played out. The value of that portfolio has increased drastically. And it's good that I wasn't thinking about crypto too much, that I wasn't watching the price every day and so on, because that could have led me to go, oh my God, this looks bad, and sell at a loss. So that's what I mean by forgetting about it, right? It's just like I was busy doing other stuff. I wasn't worried about this. If anything, every once in a while I thought about it, it's like, oh, this price is down far, but I still believe in the long-term thesis, so I immediately forget about it again. So this is great, but think about it. What if I had also earned some interest on this? What if at the same time this had been growing even at like 3% or 4% or something like that per year? That would look even better. Now, at the time, there wasn't really a lot in terms of options of how to actually do that. Can you earn interest here? As far as I know, these options didn't emerge until 2019 or so. But this is now something we can do. And this is one of the reasons to look into DeFi. This is one of the things I like about decentralized finance, right? You can have your crypto assets sitting in a lending protocol. So instead of just sitting in a wallet, they're sitting in a lending protocol. That's where you forget about them. And then you earn a few percent a year on them. And if there's another price run up like that, that turns out to be a lot of earnings, right? The same is if you have your assets, maybe you have some assets allocated to a liquidity pool. We talked about this in a previous lesson. And also what I mentioned there, like the CeFi, the centralized, decentralized finance kind of thing, like the Coinbase account where you get paid 4% on stable coins. That's the same thing, right? It's not going to be exciting day to day, but if you chuck some money in there and forget about it for a few years, it adds up. Or if you make that like one of your savings accounts, essentially, right? That's where you put in a bit of money every month. If you forget about it for long enough, all that growth that seems unexciting for the first few years starts adding up in really interesting ways. So that's kind of what I mean by the value of like forgetting about your investments, right? You're not sitting on top of it, you're not like always hovering around it and worrying about it. And here the principle of friction and how friction affects human behavior is really important. We've also talked about this before, right? This is why manual expense tracking works. We want to add friction to the process of spending money so that we're more aware of it, and that we're more likely to pause and maybe change our minds, and we're more deliberate about how we spend money and where we spend money. And on the other hand, if you do something like automatic DCA into an investment account, you earn interest. Those are things that just happen automatically. You don't have to think about it. You don't have to do anything. It just happens. And so by removing friction, that makes it easier and it makes you benefit from it in the long term. So what are ways, including the ones we just talked about, but also other ways in which we can kind of flip this friction thing around, right? Instead of adding friction to something, let's remove friction to make it easier to put ourselves on the path of building wealth without having to think about it. As I mentioned, automatic dollar cost averaging is one of these things you can do. And one of the ways to do this is, for example, Coinbase. You can see if that's available in your country with your Coinbase account. They do have this feature where you can tell Coinbase, okay, I want to put $50 into Bitcoin every week or something like that, right? And you can set that up so you can automate that process. That's great. You can also check with your brokerage app or your Robo advisor app or whatever it is you use for your stock investments. Same thing. It will depend on the service provider you use. It might also depend on the legal situation in your country. So I can't give you any like easy or guaranteed solutions here, but it's something to check, right? Do I have an option here where I can set up some kind of maybe I can charge my card automatically, or maybe I fund the account and it DCAs automatically or something like that, right? Anything where you can remove friction from doing this is going to be a good idea, basically. Then interest accounts like Coinbase Earn and a bunch of others are coming out as well. That's something to look into. DeFi, see if you want to get into that, right? It's still something where you have to get a bit technical. You have to understand how these wallets work, how these DeFi apps work, and so on. If you want to get into that, you can have a look at that and see if there's an opportunity there. Here's a screenshot of Aave. Aave is a lending protocol. And look, as you can see, these numbers are pretty unexciting. Generally, you can earn interest on stable assets. So DAI, GUSD, USDC, USDT, these are all stable assets. So that's like earning interest on dollars. You have to look at the risk of this. You have to think, okay, do I want to have wrapped Bitcoin, or do I really want to have Bitcoin in a hardware wallet? You have to think about this, obviously. But even something like this, if it's sitting here for a number of years, then that might be worth it. And this is just one example, right? And you can look at this, and this is just one example. I will link below to a staking rewards website where you can basically see for crypto assets, you can see all the lending rates, you can see assets that can be staked, where you can get staking rewards and things like that. And so if there are assets you want to invest in anyway, you can look up, is there a way to put these assets somewhere where they earn interest of some kind? I'm not saying that this is always the right thing to do. I'm saying that look at what you're invested in and see if there's an opportunity to even earn a small amount of interest or passive income on this. And if there is, and you feel like the risk reward is good, then having your assets sit there and forgetting about them for a few years might be a good move. Another opportunity to look for is there are services and cards and accounts where you can essentially auto-invest your spare change. So let's look at an example of that. Acorns is such a service where you get a card with them, which is a debit card. And what it does is it will basically round up your purchases. So let's say you buy something for $3.70. It will round that up to $4 and put 30 cents into an investment account. And essentially the idea is that you're spending money on stuff you buy, and it basically feels normal because you're just spending like tiny amounts more. But those tiny amounts add up and they all go into an investment account. And again, over time, it's only over the span of many years, can this become a real game changer. Because you're not just saving your spare change, right? You're not just like saving 30 cents. You're putting those 30 cents to work where over time, let's say the value might double over the span of I don't know how many years. Now, with all your purchasing activity that you do anyway, you're accumulating all these dollars, and the value of all these dollars is going up because they're going into these assets. Over a long enough time, that can make a real difference. And all the while, you're just spending money like you're usually spending money. So that's the idea of auto-investing your spare change. And you can look up if something like this exists in your country or region. So you can search for something like round up your spending or spare change saving or spare change investing or something like that. Like with brokerage accounts, bank accounts, and so on, unfortunately, as far as I know, there's no international option for this. So it depends on what country you're in and the rules in that country, but you can see if something like this exists. I think this can be a really good, like such a simple thing to do. Pretty soon you'll just not even notice. It's just like you live in a world where everything is a tiny bit more expensive, but you'll just deal with that, no problem. But the saving and investing that piles up can be a real game changer. Now, another thing that I'm quite excited about is crypto cashback debit cards. At this time of recording, I don't think any of them are actually available yet, but there's several companies working on creating one. Gemini, the Gemini exchange, has this wait list for the Gemini credit card. I think, this is actually a credit card. So I think they're the first ones to do an actual credit card. There's some others that are doing debit cards with the same idea. And here's the key feature, right? They're basically saying earn up to 3% cash back in the crypto asset of your choice. So as you can see here, right, it says rewards in Bitcoin or any other crypto available on Gemini. And this is really exciting because cashback, they're basically giving you back some of the fees that the credit card processor charges. And in this case, you're not spending more. So unlike with the Acorns thing, the prices that you actually pay for things stay exactly the same. But on every purchase you get between 1% and 3% of that purchase price credited to your account in what I would choose here is either Bitcoin or Ethereum. So this is the Gemini credit card. And like I said, you can also search for this to see if something like this is available in your country. There's probably all you can find is like a waiting list to get onto. But I suspect that from the time I'm recording this, we're probably only maybe a few months, maybe up to a year away from seeing this become a reality. So that is something I'm pretty excited about. But having said that, let me show you something else. So there's the Crypto.com Visa card, and there are several like this where you get a card and they tell you, if you watch the sizzle reel here, they will tell you get up to 8% of your money back, essentially 8% cash back. But if you look at the details here, you can see that the rewards are in the CRO token, which is their own cryptocurrency. It's their own token. And in order to get those 8%, you have to put in like $400,000 worth of CRO. So you have to buy $400,000 worth of this token and hold it in order to get the 8% that they're advertising in the big headline, right? So realistically, you're getting like 1 or 2%, and you're getting it in this CRO token. Which, look, if you're super bullish on Crypto.com, right? If you think Crypto.com is an amazing company and they'll, grow and the CRO token will have much more value in the future, then maybe this is a good deal. But Like for me, this is not the same thing. I don't want to earn rewards in their specific currency. I'd like to earn those rewards in Bitcoin or ETH. So for something like this, you'll have to look for regional availability, see if it's available in your region. And you'll probably have to get on a waiting list or something. They're not quite done yet, but I'm hoping they're coming soon. And like I said, avoid cards. I think you should avoid cards that pay you in their own token only as a way to basically pump their own token. That's not that interesting. For me, the reason I'm excited about this, the reason I'm interested in this kind of thing is because, getting your 1, 2, 3% or whatever it is back per purchase is not very exciting in the short term. And this is true, for the rounding up your spare change, essentially. That also probably amounts to like 1 to 3% per purchase, right? Or cashback 1 to 3%. Like that's not going to amount to a lot of money. But the interesting thing is that you're putting it into an investment. So if you're putting it in an index fund, if you believe that the value of this index fund is going to be, 2x, 3x, 4x what it is now in the future, or you put it into crypto, you put it in something like Bitcoin, and you believe that the value of Bitcoin is going to be 10x or 100x what it is now in the future. Like if you turn out to be right about that, then getting 1 to 3% cash back on every purchase is a huge win. I mean, let's take the extreme bull case and say that the value goes up 100x and you hold for that long, right? You don't sell for that long, however long that takes. If you get 1% cash back, you do all your purchases through this card, and eventually the value of the thing you're getting cash back in is 100x, basically means that all your shopping was for free. And that is pretty cool. So the growth potential of the asset is pretty cool. And what I also like about this is there's no real downside, because if you get your 1 to 3% cash back in Bitcoin and then Bitcoin goes to zero, all the Bitcoin hedgers turned out to be right. Okay, well, what happened? You just didn't make a gain, but you didn't actually make a loss. And that's really, really cool. So that's why I'm pretty excited about this. And this is a great example of essentially a zero-brain investing approach. So to summarize, some zero-brain wealth building strategies include automatically dollar cost average into index funds, set it up once, just leave it running, long-term assets earning interest, anything. This could also be dividend stocks, although that's a whole conversation whether dividend stocks are actually more valuable than non-dividend stocks, but anything where you have an asset that also pays you over time, and especially if there's some compounding effect there, that can be really interesting. Auto investing your spare change into index funds through one of these cards, or cash back in Bitcoin or Ethereum. Those are strategies that personally I think are worth having a closer look at to see what you can set up and how, which one of these you want to benefit from, because some of them are like mutually exclusive, right? You're either going to do like the spare change into investments, or maybe there's also like cash back into investments. I haven't seen that, but might be worth looking for too. But basically you're going to have one card that has one of these features if that's what you want to do. So that's worth thinking about and deciding which is the right approach for you. And mainly, it's really worthwhile to think about, okay, what other lazy ways to build wealth can you discover? And be on the lookout for that, because the underlying idea here is that of friction, and thinking, how can I add friction to things that I want to avoid that take me away from the path of wealth building? And how can I remove friction that put me on the path to wealth building and make those things as easy as possible? If you discover some other opportunities like this, let's have a discussion about it. Let us know in the community. Maybe we can collect some other interesting zero-brain wealth building opportunities. Here's a quick bonus idea on the topic of replacing bad financial habits with good financial habits, and very specifically, replacing a bad habit with a high risk reward investment. So to explain what I mean with this, let's look at what's probably the ideal example of this, which would be the bad habit of smoking cigarettes. Because smoking cigarettes is both unhealthy and it's costly. And it's one of those things, right? Basically, almost everyone who smokes wishes that they could quit. They're trying to quit and struggle with it. And of course, it's difficult to quit. But one of the things that can make quitting easier is if you have a replacement habit. So if you have this habit of smoking and you just go, okay, I just want to stop it leaves like this gap in your life, right? It leaves like a void. And that makes it really hard. But if you say, instead of smoking cigarettes, I'm going to do something else, that can make it easier. The problem there is that often, well, what else am I going to do? Maybe I'm going to snack, right? I'm just going to eat snacks all the time whenever I have cravings for cigarettes. So then we're replacing a bad habit with maybe a slightly less bad habit. So here the idea is, what if you could replace this bad habit with a habit that is actually good for you and that is good for the future of your financial life? So think of it like this, right? With cigarettes cost something like $5 to $10 a pack, depending on where you live. But that is, I think that's pretty typical in many regions of the world. It kind of depends on how much it's taxed. But let's go with $5 to $10 per pack. We can average that out to, let's say, $7, okay? Now, that means if you smoke 2 packs a week, that will come out to over $700 per year. If you smoke a pack a day, that's $2,500 per year. So we're talking about pretty sizable amounts of money here. So that's the financial cost here that is added on top of the health cost, which in the case of cigarettes is definitely more severe, right? That's the worst part of it. It just also happens to be expensive. So the idea here would be that as one of the things you do to try and replace this habit is that you make a new habit of taking those $7 that you would spend on a pack of cigarettes and instead taking those $7, putting it towards an investment. And to do this, of course, you want to find some low friction way of doing this. So one example of that could be that you load up a exchange app, maybe you have your Coinbase app or something like that. You load that up with some money. So you fund that account and then you can easily just make a transaction. You can easily buy your $7 worth of Bitcoin, for example, every time that you usually would go out and buy a pack of cigarettes. So then you can really replace one action with another action. And you can feel like, yes, I'm spending this money and I'm not losing this money. I'd be spending this anyway. And I'm doing something good for myself. I'm doing something good for my future instead of the habit that I'm trying to replace. Now, I wouldn't expect that this alone will just immediately make it easy to quit smoking, right? I think that's something you have to add to whatever other quitting strategies you're using. But I think it can help because it also gives you like that sense of meaning of actively doing something good for your future rather than just avoiding something that's good for your future. And another way to approach this, and maybe that's once the early phases of quitting, like once you've gotten through the really hard part and not smoking has become a habit, then you can look at what used to be your monthly expense for cigarettes, and then you can DCA, dollar cost average, that as a weekly or monthly thing you do. There's ways to automate this. There's ways to automatically do your DCA, but you might actually want to do this manually. Again, just to reconnect with that purpose, to remind yourself, this is the amount of money I would have spent on cigarettes this week, and here's what I'm doing instead. And to keep that alive, make that a manual thing, that could actually be an advantage here. So that's the example of cigarettes. And of course, there's lots and lots of other bad habits that you might want to overcome where you could use the same approach and the same logic. I've used the example of Bitcoin here, and we can have a look at our Bitcoin DCA here to get a sense of how this could play out. So if we go back to our dollar cost averaging calculator here. So we had a cost of like $700 to $2,500 per year in our example. So let's go with 100 a month. That would be $1,200 per year. That's somewhere in between those two numbers. And then let's see what would happen if we keep this up for a few years. Let's just go to not too far back here, maybe 2018, and calculate what that would look like. So here's our graph, and here's, you can see over 4 years, in total we would have put in $4,000, and we would have increased that to $16,000. And that's just the example of, this would be $100 a month spent on Bitcoin instead of cigarettes over a period of 4 years. Just as an example of how this could play out. As always, historical returns do not indicate or guarantee future returns, but it gives us a sense of what could happen. Now, I've been talking about Bitcoin here, and I mentioned a high risk return investment. And maybe you're wondering, why am I recommending that? Why am I talking about specifically a high risk return investment? I think for this kind of replacing a bad habit strategy, this is ideal. Because of course, you could just put this money into a savings account. You could just stack dollars or euros or whatever. And you would still get that effect where it's like, oh, you have this money, and it's nicer to have this money and not have the bad habit than to not have the money and have the bad habit, obviously. But just saving up a little bit of money like this is less exciting. And I think that for something like this, it really makes sense to go into a high risk, high return investment. So something like Bitcoin or Ethereum or something like growth stocks or something like that. And here's the reason. A high risk return investment usually has greater volatility, certainly greater volatility than something like a savings account, but also greater volatility than something like a diversified safe investment basket, right? It has greater volatility and it has a chance of producing greater returns, but also a greater chance of producing losses. Now, usually this is something we have to take into account when we try to figure out how much risk we want to take on. But in the case of replacing a bad habit, you really almost don't have to consider that at all. Because think about it. The worst case scenario for a high risk return investment is that you lose all of your money. And if we're talking about something like growth stocks or Bitcoin or Ethereum, well, the likelihood of losing everything is pretty low. And if we hold for a long enough time, the likelihood of making a huge loss is also pretty low. It's not zero, and it is a greater risk than many other types of investments or many other things you could do with that money, that's for sure. But it's not like there's a 50-50 chance that you lose everything. That's not what the risk looks like here. But be that as it may, the worst case scenario, technically the worst case scenario is that you lose all your money. And that is still better than the best case scenario if you keep your bad habit. If you keep smoking, you also lose all that money, right? You're spending that money on cigarettes and it's all gone, guaranteed. It's 100% guaranteed loss of all of that money. Plus, it's bad for you. It might cost you like 10 years of your life or something. So the worst case scenario of putting all that money into a high risk, high return investment is still better than the best case scenario if you keep the bad habit. So to me, this is the perfect reason to put money into something riskier with greater chances of return. And it's also like the perfect excuse to do it if there are maybe people in your life who are like, oh my God, what are you doing? You'd be like, look, I'm literally risking nothing here and there's something to gain. Also note that this would be in addition to whatever else you are doing. So I would still recommend that apart from this, you have like this bad habit fund and you put that into high risk investments. And I would also obviously recommend that you still do all the other stuff we talked about. You still save 10% of your income and you do all the other stuff that we talked about with that money, right? And if you do that, then this is literally a no downside play that could make a huge difference to your wealth in the future. I'd love to hear your thoughts on this, and also if you have specific strategies or ideas of how to implement this, let's talk about it. So jump over to the community and let's have a discussion about this. Let's look at some example investing strategies of how your allocation of cash into assets could end up looking like. And as always, the goal here is to talk about the way to think about this and the way to come up with a good strategy rather than just say, hey, do this. Because the reason I'm saying this is example investing strategies and not the best investing strategy is that the best strategy only exists in hindsight, right? In hindsight, you can look back and say, well, in the last 10 years, the best place to put your money would have been X, right? Then you can determine if something was a good or a bad strategy and which one was better or worse. But looking forward, you simply can't know. So with that said, regardless of the investing strategy, we're talking about basically the allocation of assets here. And regardless of how you do that, what is always a key play here is what we talked about before, is increasing your income, widening the gap between your income and expenses. That's basically always a great move to make, no matter how you want to allocate your assets. So when it comes to choosing an allocation and how to configure your investments, so to speak, I think to simplify this, we can break this down into essentially two questions. And those two questions are, number one, how do you build your runway? And number two, how do you allocate your investments? So let's start with the runway. And here, of course, we need to figure out how many months of runway do you want? And then you have to know what that number is. And Obviously, that number can also change because if you reduce your expenses, then the same number of dollars stretch into a longer runway. So this can also be variable. And that's one of the reasons why we always have to know what our expenses are. But that's kind of the main question, right? How many months do you want? And maybe the answer for you is 3 months, maybe it's 12 months, maybe it's 3 years. That's basically up to you. You have to know to which extent do you want to build out your runway. And the second question is, do you want to build your runway and investments in parallel or in sequence? So to explain what I mean, I think there are basically 3 approaches here that make sense. The first approach would be a 100-0 approach, which is to say that you have a target runway number and you're going to put all extra money into your personal runway account until that number is reached. Until that number is reached, you don't do anything else with your cash, right? All of your cash goes into your personal runway. So this is like, the idea is I just want to get to that runway number as fast as possible, and all the other stuff with assets and investments and so on, I'll worry about that later. That would be the 100-0 approach. Another approach that can be useful is a 90-10, where you say, my main priority is to build up my runway, but I want to start becoming an active participant in the world of investing already. As an example, let's say this month, I am putting $500 towards my personal runway. And that's the major thing I'm doing. That's the major move I'm making for my financial future. But also, I'm putting $50 into my stock brokerage app, and I'm buying an index fund or I'm buying a stock. Where, look, these $50, even if I pick the best stock ever, these $50 are never going to turn into a significant amount of money. Even if I have incredible growth, right? I pick an amazing growth stock, the value doubles in the next 3 months. Well, I've made $50. It's like not going to be life-changing no matter what. So the value of putting these $50 in is not that this is going to change my financial destiny. The value of it is twofold. It is, one, I'm becoming an active participant. I'm becoming an active player, and it's no longer kind of a foreign and strange thing for me to think about investing and play with investment, essentially. And number 2, if I do it on a regular basis, as we saw when we talked about DCA, the $150 isn't going to change your financial future, but $50 every month over a long enough time can indeed change your financial future. So that's what I think the value of this 90-10 approach is. You're still building up your runway almost as quickly as possible, but you're already doing a little bit. You already have like 1 foot in the door of the world of investing. And then finally, another approach that I think makes sense is 50-50. We say, I'm going to do both at the same time. So if I have $500 if the gap between income and expense this month is $500, I'm going to put $250 into my personal runway and $250 into my Robo advisor or my index fund or whatever it is that I do on the investment side. Here, the downside, of course, is that you're building your personal runway more slowly. And the risk is that it slows you down even more because the 50% that you put into investments, maybe you see a value collapse on that side. But if you want to be an active participant, you want to get in on the investing side earlier on, I think a 50-50 approach can make sense. Now, once you reach your personal runway number, this kind of thing actually applies again, because then the question is, okay, do I go 100% do I put all of the other money into investments now? Or do I want to go like 90-10, where I put most of my money into investments, but I also just want to keep building my personal runway? Or do I keep going 50-50? So this same kind of question and these same scenarios just flipped over apply once you hit that milestone of your personal runway as well. And again, if you're wondering, well, which is the best strategy? There really is no best strategy here. You'll know in the future when you look back, you can say, well, this would have been a better strategy. But really, it doesn't matter. You can't know looking forward. I think the key point, the key way to choose between these different strategies is psychological and subjective. What feels best to you? If you're super excited about starting to invest and learning about that world, then putting all of your extra money only into your runway and like preventing yourself from starting to dabble in investing, it doesn't make much sense. Like a 90-10 or even 50-50 approach makes much more sense in this case. On the other hand, if the main thing you want is just like that sense of safety and security that comes from having the runway, then a 100-0 approach makes sense. So really, it's mostly about what you feel about these things and what you think you can best stick to. Because as with any strategy, the key is you have to stick to it. So with that said, let's start talking about investment allocation. So this is once you've reached your milestone number, or if you have like a 50-50 approach or something, once you have to make decisions about how do I allocate significant amounts of money into all the different possible investments. So here, let's quickly think about this. How do we decide this? How should we categorize the investments we can make and where we can put our money? Here's my thinking on this. We've already looked at asset classes. So, stocks, bonds, cash, crypto, real estate, etc., right? These asset classes, I think, are not the right way. I think they're not the most useful way to think about allocation in terms of strategy. Risk, we can talk about how risky is an investment, and that gets close to it. But really, we're only considering investments where we think that the risk-reward ratio is worthwhile. I mean, we're only putting money into stuff where we think, okay, there's some chance that I lose money, but I think the upside is worth it and is more likely. So just thinking of it in terms of risk also doesn't quite meet the criterion. Now, if we think about it in terms of risk reward, so the ratio of risk to reward and volatility, so like the size of price movements that we can expect in the future, I think that gets closer to something that I think is useful as a way to distinguish between investment categories. If we ask ourselves, what's the expected magnitude of price movements on the way up? Because obviously I'm only putting my money into something that I expect to go up over a long enough time frame. And if I'm not a trader and I'm not a gambler, essentially, then we're talking about long time frames. I want to put my money into stuff where I think that 10 years, 20 years, 30 years from now, this is going to be worth more than now. And there's some risk where it's like, maybe I'm wrong about that, right? And it's also unclear, like, by how much is it going to go up? And so one of the questions is like, how much volatility, how much in terms of like violent price swings do I expect to have to endure on the way up, even if I'm right? And then the other question, this is essentially the risk question, is like, well, what are the chances that we experience a considerable and permanent loss with this investment? This is essentially how I think about different types or different categories of investments. And here's my take, and this is just my take, right? If we think about what is like a near zero, so a near zero price movement and near zero risk of total loss, that would be things like cash, bonds, savings accounts. So with all of these, you're basically going to lose money, but very, very slowly, because the value of your money is going to be inflated away. So if you have your cash in a savings account, you get some fraction of a percent in interest, but that doesn't really matter because you have something. And one of the problems with inflation is you can't expect your government to tell you the true inflation numbers, unfortunately, right? There's a huge moral hazard that incentivizes the people who do the reporting to underreport. So officially, inflation numbers for strong currencies like, US dollar, British pound, euro, etc., officially, these inflation numbers are usually like 2%, 3%, maybe up to 5%. The real inflation is almost certainly above that, but that's essentially the rate at which your money is losing value. And that is also compounding, so it is pretty significant. If you just sit on cash over a long period of time, a large amount of cash, you suffer huge losses over a long period of time, right? But this loss in value is generally controlled and slow, right? It's not a sudden spike downwards. And if we talk about these strong currencies, then it's very, very unlikely that there's like a sudden crash to zero. So that's why this is like a near zero movement and risk type of investment. Next would be low risk assets. That would be like broadly diversified equities, right? Broad index funds, your Robo advisor portfolio, which will probably be some index funds, maybe even have some real estate and commodities and stuff mixed in there, right? Super broad diversification, that's a low risk asset. Medium risk assets, these are like more thesis-based funds, more narrow index funds. Real estate, I would put into this category because there can be fairly violent price swings in real estate. And the crypto basics, basically Bitcoin and Ethereum, maybe including something like the DeFi Pulse Index. There are some crypto index funds that, maybe will turn out to be in this class, but it's too early to tell. So to me, this is all medium risk asset. Then higher risk concentrated bets would be picking individual stocks, picking even narrower funds. Examples of this we looked at are some of the ARK Invest funds, like the ARK Invest Genomics Fund. That's a fairly narrow, it's pretty strong, high risk reward kind of thesis. And then basically, loads and loads of like big crypto projects, trusted crypto projects are still definitely in the concentrated higher risk category. And then finally, moonshots. That would be, small cap stocks, meme stocks, investing in startups, investing in almost all crypto projects, anything with leverage. If you take on leverage in order for whatever, right? Leverage increases volatility and risk. So if you take on leverage to buy safe real estate, you can still get totally wrecked. Options and lots other. I think the moonshots are basically the ones that are the easiest to recognize, right? Those are the ones that really are more like gambling than anything else. So this is, to me, a useful categorization if you're thinking about how to allocate assets. As I'm sure you've noticed by now, I am more optimistic about Bitcoin and Ethereum and the crypto space in general than most people in the mainstream would be. And this is where, a lot of, if you show this to your financial advisor, if you have one, they'd probably disagree with me. The mainstream view of something like Bitcoin is still that, if you've put $10 into Bitcoin, you're just a degenerate gambler and you have no idea what to do and we have to regulate you and control you and put you in a straitjacket and so on. My views are different on this. To me, this is not a riskier asset class than something like real estate. But like I said, only in hindsight will we be able to look back and see whether I was right about this or not. And I'm just mentioning this to say that nobody knows any of this for sure. These are all just models. And hopefully you can come up with models that make sense for you and make your own decisions. So with that said, let's look at a couple of different allocations. One thing to consider here is that your portfolio and allocation will change as your net worth grows. So an early stage portfolio would look something like this. You can see the legend at the top, right? The lightest shade would be near zero. And then the darker the shades get, the more we get into higher volatility, higher risk reward type investments. So early stage portfolio would probably look something like this. 80% would be like in cash essentially. And then maybe 10% low risk, 5% medium risk, 5% concentrated bets, something like that. And that is simply because, if we're talking about $10,000, let's say, that would mean 80% is $8,000, depending on where you live, what your expenses are. That's probably only a few months of runway, right? Some places of the world it's longer, but you get what I'm saying, right? If your total net worth is low, even if you have 80% or 90% in your personal runway, that's still not a very long runway. That's the point. So early on, you will have an allocation that looks something like this. But as your net worth grows, this will change and that near zero part will become much smaller and smaller. Now, if you're super risk averse, then it might look something like this, where you still, even with a larger net worth, you have like 40% in cash and maybe some bonds or something like that. And you have maybe 40% in low risk assets and maybe 20% in medium risk assets. Like this very risk averse approach. So in my opinion, because of the inflation thing we talked about, right, at a certain point, the larger that sum becomes that you have in cash, bonds, and savings accounts in the near zero category, the more you're really just losing. And if we use large enough numbers, this becomes apparent. If we imagine that you have $10 million in cash and inflation is, let's say, 5%, 10% of 10 million is 1 million. So 5% is $500,000. You're basically losing $500,000 a year if you just have $10 million sitting in an account, right? That is very, very significant. So the larger your wealth, the more having huge amounts of wealth in these near zero assets really doesn't make sense anymore, because you're just paying so much for that, for what little security it provides. So again, as your net worth increases, this allocation will probably also change, even if you're risk averse. So let's look at some other examples. So this would be a more growth focused configuration. And again, this makes sense if you look at that 40% number in the near zero assets. So this makes sense if your total net worth is at least twice your runway number, right? Then this kind of thing starts making sense. So here, 10% low risk assets, 30% medium risk, 17% concentrated, and 3% moonshot. This is like, look, your 3% moonshot is also for fun, basically, right? Are you going to get a return on that? Who knows? But it can be fun. And this is a kind of allocation where you're not doing anything irresponsible, in my opinion. So this would be an example of a growth-focused portfolio. And this means that you will definitely see the value of this portfolio shrink and grow. And you have to be someone who can stomach that, right? It was like, oh crap, this month I lost a few $1,000s worth of value. Am I cool with that? because that would be a pretty regular occurrence. And the same is like, oh, this month the portfolio value went up by a few $1,000s. Am I going to immediately freak out and put all of my cash into a moonshot because I'm so euphoric about it, right? You have to be a bit more even-keeled in order to handle a portfolio like this. Next, high income portfolio. I wanted to briefly talk about this. We have to consider income and income security as well. If your income is really high and you have a skill set that's highly in demand, you can also take that into your kind of risk calculation, right? Where you can say, okay, I have really high income and I believe that I have a good chance that even if I lost my job or something, I could immediately find work again, or, you know, in my current business, if I step out of this or something goes wrong here, I could start up a new one very quickly, something like that, right? If you're in a high income situation where you can basically say, listen, even if my investments don't work out, I'm still going to be relatively wealthy, then you can also take on way more risk in your allocation. So here would be an example, right, where we have essentially 50% of the portfolio is in moonshots and concentrated bets, and 25% is in medium risk, and very little is in low risk. And the runway, we'd still have a considerable runway, but it's a smaller percentage because of how much value we're talking about. And I'm showing this because I want to show how I think about different variables affecting this portfolio, right? If someone comes to me and says, I have really high income and high income security, and this is how I allocate, then I would look at that and say, that makes a lot of sense, right? That makes a lot of sense because you still have a decent amount of your net worth in medium kind of, you know, there's probably going to be growth. Even if your high risk and moonshot stuff goes wrong, this is still going to work out in your favor. But if someone comes to me with no income security and low income, basically struggling on the income side with an allocation like this, it's like, you might be gambling, you know? And speaking of that, right, if you have a portfolio like this, then you have a gambling problem. And I also show this because this is, I mean, there's a lot of people who have portfolios like this. This is the kind of people who have discovered trading through apps or whatever, and they buy meme stocks and whatever, which I'm not categorically against. But if your allocation looks like that, you know, if you buy a meme stock because you're like, oh, I think I know what the next meme stock is, and you put a portion of your net worth into that as a moonshot, that makes sense. But if you go all in on a meme stock, then yeah, you've got a gambling problem. So those are some examples. And the main thing, again, as you can see, right, I'm still basically refusing to tell you what to do with your money. And I think that is a key part here. I do insist on that. To me, the key value in all this is the value of deliberate action. Okay, I think the most important thing is that you clearly think about what you want to do with your money, how you want to allocate, how much risk you want to take on, and you design a strategy that you can look at and say, I understand why I'm doing this, right? I'm not just kind of drifting into this. I'm not just doing this because I got swept up in the excitement of something. I'm doing this because I really thought about it, I understand it, and this is the deliberate choice I make. And whatever choice that looks like for you, that is, I think, the ideal place to be on the path to building your personal wealth. Boom! You've made it all the way to the end of this class. Congratulations for that. You can give yourself a pat on the back. Not many people make it all the way through. Now, did you find this helpful? Do you like that we're putting this out completely for free? If so, you can help us help more people by sharing this. Maybe give it a like. Maybe tell a friend about it, send this link to someone, and help us reach more people with this. Also, if you want more of this kind of thing, I do recommend that you check out the class version on the Icario website, also completely free. I will also be adding new lessons and bonus lessons and things like that there. There are already some bonus recordings there of conversations we've had with the community. So if you want to dive deeper, that is the place to go next. That is it from me, for now at least. Thank you for watching this. Thank you for helping us spread the word by sharing this. And I hope this makes a huge difference to your financial future.